Check, sound check, sound check. Check, sound check, sound check. Okay, good evening, my dear students. So let us now start with your marathon lecture for your Inter CA Financial Management. So my dear students, what will be covered first of all in this marathon is all your important chapters, all the important concepts, and also at the same time all the important questions. So my dear students, I just want you all to be with me, focus properly, and as and when I am presenting something, if you want, you can write down all those things in your notebooks. Okay, keep on practicing with me, but the pure intent is that today in maybe like 3.5 or 4 hours we'll try to complete all the chapters, important concepts, important formulas, expected questions, and also your important questions as well, which can be asked in your examination. Okay, so the chat box is open for you guys. So whenever I ask you something, please participate. Try to tap in the chat box as well. Good evening. And also at the same time, if you have any doubts, difficulties, etc., you can at the same time ask in your chat box and I'll be very happy to help you out with the same. Okay, so without wasting any further time, let's get started now with the very first chapter in your marathon, and that is pertaining to your cost of capital. Okay, so very quickly, my dear students, whenever we are discussing your cost of capital, so cost of capital here primarily means what? That we are going to learn how to calculate the effective cost of the capital which is being employed. So whenever we are going to deal with your effective cost, can I say effective cost primarily means what? The cost which is after tax implications. Come on, yes or no? Yes, sir. So this is nothing but the cost which is after tax implications. So whenever we are going to deal with your effective cost which is after tax implications, so what we are going to do is we are going to calculate the post tax cost. Okay, so in this particular case, when we are going to calculate the cost of the capital, your capital primarily means your capital employed, and this capital employed will be having your combination of debt and equity. So whenever we are required to calculate the cost of debt, so that debt will always be long term in nature, and your equity will constitute of 4 important things, and that will be your equity share capital, preference share capital, reserves and surplus, minus miscellaneous expenditure not written off. But we are concerned here with calculation of cost of all these major sources of funds. Okay, so whenever in the question, if it is specifically given to you that you are required to calculate your cost of debt, always remember that in cost of capital we calculate the cost from the long term perspective. So if suppose they have given to you that you are required to calculate the overall cost of capital for the following capital structure, in which they have given to you equity share capital, they have given preference share capital, they have given long term loans, they have given reserves and surplus. At the same time, if they have given to you 10% debentures, then they have given to you bank OD, and if suppose they have given to you short term loans or creditors, then in this overall cost of capital, are we going to calculate the cost of bank OD, short term loans and creditors? Then the answer is absolutely no. Why? Because your capital employed always deals from your long term perspective. Okay, so primarily 2 main things we are going to learn in your cost of capital: how to calculate the effective cost, that is after tax implications cost, and second, the word capital implies your capital employed, which constitutes your debt plus equity both. Okay, and by the word debt we actually mean long term debt, and by the word equity we actually mean your shareholders funds. Okay, now after all these things, my dear students, we are going to learn various formulas which will be taken into consideration. So in this cost of capital, in the first part of the revision, I will be revising your formulas for specific cost of capital. So we are going to learn specific cost of capital. So what do you mean by specific cost of capital? That how do we calculate your cost of debt? Suppose if I'm talking about your KD, cost of debt. Now this cost of debt, if it is irredeemable in nature, then we'll be taking into consideration whatever is your interest into 1 minus tax, and we divide that by the net proceeds into 100. So my dear students, very simple concept, that whenever it is irredeemable or perpetual debentures and the life is not given to you, and if you want to calculate the cost, then we calculate the effective cost, that is interest into 1 minus tax, divide that by the net proceeds and multiply that by 100. Now whenever we have to calculate the interest, always remember this interest will be calculated on the face value and we multiply that by the coupon rate. And whenever we are talking about the net proceeds, this net proceeds is nothing but the market price of the particular instrument. So can the market price be also taken into consideration for net proceeds? Yes or no? Of course yes. And this net proceeds, my dear students, can also be the total amount which is received by the company at the time of issue. So it is very much possible that this debentures can be issued at a premium and there can be some flotation cost or some issue expenses, etc. Then what we need to do is we have to subtract these kind of flotation cost or issue expenses to ultimately get what is going to be the net proceeds. So the first formula to calculate your KD is what? Interest into 1 minus tax, which we divide that by the net proceeds and multiply that by 100. Then my dear students, if the cost of debt you have to calculate for redeemable debentures, then in that particular case we'll be taking KD is equal to interest into 1 minus tax plus whatever is going to be your redemption value minus your net proceeds upon n, and this is something which we are going to divide it with what? Redemption value plus net proceeds upon 2 into 100. So is this also a way to calculate your cost of debt? Yes or no? Yes, but this formula will only and only be applicable when your debts are redeemable in nature. Okay, and when they have specifically given to you that this debentures will be redeemed at the end of 5 years, at the end of 6 years, at this much premium, and that will be available to us, so we are going to calculate the KD accordingly. Okay, now my dear students, here also net proceeds means what? The issue price of the debentures, or also at the same time what can be the market price of the debentures. So if the market price is given to you, we can substitute that. Then my dear students, we can calculate the cost of preference shares also, which is also called as your KP, and this KP can be calculated by taking, if it is irredeemable in nature, then it will be preference dividend, which we are going to divide that by your net proceeds into 100. So what is the formula for KP? So KP is nothing but PD upon net proceeds into 100. Okay, if they are irredeemable in nature. Will there be any tax consideration for the same? Then the answer is absolutely no. So here there is not going to be any tax saving, so that's why no 1 minus tax. And whenever there is KP redeemable, the same concept will apply, and that will be preference dividend, and that will be plus whatever is your redemption value minus net proceeds upon n, and we are going to divide this with what? The redemption value plus net proceeds upon 2 into 100. So on this particular basis we can calculate your specific cost of debentures, which can be irredeemable and redeemable, and cost of preference shares, which can also be your irredeemable and redeemable in nature. Okay, now my dear students, at the same time when you have to calculate the cost of equity, so cost of equity, my dear students, whenever we have to calculate, always remember that KE cannot be calculated in one particular way. To calculate your KE, there are different type of approaches which are going to be there. Now why are there going to be different type of approaches? So it's a very simple concept, that cost of equity is nothing but whatever is the expectation of equity shareholders, because as you all are aware that equity dividend is not mandatory. So if I am the company, you all are the equity shareholders, you all have given me the money and I have to give you some type of cost, right? Now in this particular case, if I don't distribute the dividends, then also it's fine. If I'm not going to distribute the dividends, can I put it like this, that you will still expect something from me? Come on, yes or no? Then the answer is absolutely yes. So in that particular case, we need to calculate what should be your KE. Okay, very good. For those who are answering in the chat box, extremely nice. Hi Ishant, Tarun, very good everyone. Chalo, good evening. So please keep on answering in the chat box as well. Make it participative. Now also at the same time, whenever we are required to calculate your KE, then what is the basic objective of KE? KE is nothing but the expectations of equity shareholders. So whenever we are required to calculate your KE, we have to first understand what is going to be the expectation of equity shareholders. So to calculate the expectation of equity shareholders, what we need to do is we have to identify different type of approaches. So what are the different type of approaches on the basis of which your KE will be calculated? Now the first approach which we are going to use is something which is called as dividend yield approach. So my dear students, whenever we are dealing with your dividend yield approach, one very simple concept which you have to understand, that we assume that the dividends are not going to grow at a constant rate. So dividend is going to be constant till perpetuity. So just imagine something like this, that for example the company has distributed a dividend of rupees 10, and if this rupees 10 is going to grow, is going to be constant towards its perpetuity, then in this particular case, how do you calculate your KE? So this KE will now be calculated by taking whatever is your dividend per share, you divide that by market price per share into 100. So this is something which is called as your KE. Also at the same time, if you want to calculate your KE using your earning yield approach, then to calculate your earning yield approach, what are we going to do is we will be taking KE, and that KE will be EPS upon market price per share into 100. Now I am expecting that something from this can be asked in your examination, where your dividends or earnings can be constant towards its perpetuity. So when you have to calculate your KE, then we can use this formula of KE, which is nothing but DPS upon MPS into 100 or EPS upon MPS into 100, and based on this we can calculate what can be your KE, expectation of equity shareholders. But again, one of the most important part is what, that we can also calculate your KE using your dividend yield growth approach. Yes, my dear students. So whenever we are dealing with your dividend yield growth approach, what do we do is we will take into consideration whatever is your D1 and we divide that by P0 into 100 plus your growth rate. So my dear students, your D1 will implicate what? It will implicate what is going to be the expectations of equity shareholders from the company when it comes to your equity dividend. So whenever there is an equity dividend and which is supposed to be received at the end of year 1, then in that particular case, are we going to consider D1? Come on, yes or no? Yes, sir. So this approach has to be used under what circumstances? That whenever the growth rate is going to remain constant towards its perpetuity. So in that particular case, are we going to calculate your KE? Come on, yes or no? Yes, sir. And this KE will be calculated by considering D1 upon P0 into 100 plus G. Okay. Then my dear students, we have something which is also called as your earning yield growth approach. So whenever we are dealing with your earning yield growth approach, what are we going to do in this particular approach? We'll be taking KE, which is nothing but E1 upon P0 into 100 plus G. So whenever we are dealing with E1 or D1, what does it mean? It means that it is nothing but the expectations of the equity shareholders from the company at the end of year 1 when the growth rate is given to you in the question. Okay, so whenever there is growth rate, we are going to take into consideration D1 upon P0 or E1 upon P0. So this D1 will be calculated by taking last year's dividend plus your growth rate, and this E1 will be considered by taking into consideration your E0 plus your growth rate. Okay, so that will imply what is going to be the expected earnings and what is going to be the expected dividends at the end of year 1. Okay, then my dear students, your P0 can also be replaced by net proceeds. So remember something like this, that whenever in the question they have specifically given to you that the company is going to issue new equity shares. Now whenever the company is going to issue new equity shares, it is very much possible that the new equity can be issued at a price which is below the market price of the equity share, or else it is also possible that there can be some share issue expenses. So in that particular case, this denominator of P0, can it be replaced with your net proceeds? Come on, yes or no? Of course, yes. And also at the same time, in your earning yield growth approach also, we can consider whatever is your net proceeds and do that accordingly. Okay. And then we have one more approach to calculate your KE, and that can be done with the help of your capital asset pricing model. So whenever we are dealing with your CAPM approach, how do you calculate your KE for your CAPM or capital asset pricing model? So we are going to take into consideration your RF plus RM minus RF into beta. So your RF will be called as your risk-free rate, and whenever, my dear students, we are dealing with your RM minus RF, this RM minus RF is actually called as your market risk premium, and beta is actually called as your sensitivity index. So my dear students, sometimes in the question they can give you a data like this to confuse you that, for example, the market risk premium is nothing but 6%, and if they give you the risk-free rate which is 7% and the beta of a stock which is 2, then how do you calculate your expectation of equity shareholders? So here in this particular case, we take your KE by taking 7% plus. Now because it's market risk premium, can I say market risk premium itself means what? RM minus RF. So what is RM minus RF? It's nothing but 6%, and we multiply that by beta which is 2. So in this particular case, it will be 7% plus 6 into 2, 12. So ultimately 19% will be your expectation of equity shareholders. So remember something like this. If they use the word market risk premium, it means that RM minus RF is already taken into consideration. But also at the same time, my dear students, if they give you the word security risk premium, now the security risk premium is always after considering the impact of beta. So what is your security risk premium? That is nothing but RM minus RF into your beta. So if suppose they give you that the security risk premium is 10%, it means what? That already from RM minus RF, can I say beta is already multiplied, yes or no? Then the answer is yes. So what you need to do is to calculate your KE, we will take RF plus security risk premium and your RF, which is, let's say for example in our case 7%, we directly add security risk premium of 10% to get your KE, which is nothing but 17%. So it all depends on what is going to be your expectation of equity shareholders, in which approaches and what kind of data which is given to you, and based on that we are required to do the calculations. Okay, so till now, my dear students, I have made you revise the 9 formulas. Now what are these 9 formulas? The first one is what? That when you have to calculate your KD, which is irredeemable, we take interest into 1 minus tax upon net proceeds into 100. When the KD is redeemable, we take interest into 1 minus tax plus RV minus NP upon N, and that is something which we divide by RV plus NP upon 2 into 100. And then, my dear students, when we have to calculate your KP irredeemable, so your KP irredeemable, my dear students, that is simply nothing but whatever is going to be your preference dividend upon net proceeds. And when it comes to your KP redeemable, same process, PD plus RV minus NP upon N, the whole upon RV plus NP upon 2 into 100. So all these formulas we have revised till now, and also at the same time, we understood how do we calculate your KE. So to calculate your KE, which is the expectation of equity shareholders from the company, there are few parameters which you have to understand, that whatever is the expectation of equity shareholders, that is the cost for the company. So how do you calculate the expectation of equity shareholders? So in that, 5 approaches I've taught you, which is dividend yield approach, earning yield approach. These 2 approaches will be used when your benefits are constant towards the perpetuity. Dividend yield growth approach, earning yield growth approach, this concept will be used when the growth rate is given to you in the question. And CAPM approach when we have RF plus RM minus RF into beta. So based on that, my dear students, we can calculate different expectations. Okay. Now, my dear students, this entire chapter has something which is called as your specific cost of capital and something which is called as weighted average cost of capital. Now, when we are dealing with weighted average cost of capital, this is also known as your KO, overall cost of capital. So whenever we are dealing with your overall cost of capital, you have to understand that this overall cost of capital, or WACC, this, my dear students, can be calculated, this WACC can be calculated by using either book value weights, by using either market value weights, or by using marginal value weights. So what are the 3 types of weights, my dear students? The 3 types of weights to calculate the overall cost of capital is nothing but number 1, book value weights, number 2, balance sheet, market value weights, and number 3, marginal value weights. Now here there are some key points which I want you all to remember. Whenever I'm dealing with your book value weights, this book value weights are also known as your balance sheet value weights. So what happens in a balance sheet value weights is, let's say for example, you have in your question sources of funds which is given to you: equity share capital, reserves and surplus, preference share capitals, long-term loans, then there is 10% debentures. So all these are your sources of funds. Now, how do we calculate the weights? Now, to calculate the weights, we have to definitely take into consideration your amount column. Now, this amount in your book value weights will be primarily taken from where? From your balance sheet. So let's say, for example, from your balance sheet, your equity share capital amount is, let's say, 1 lakh. Your reserves and surplus is 50,000. Your preference share capital is 2 lakhs. Then your long-term loans is 50,000. And let's say, for example, we have 10% debt, that is 50,000. So in this particular case, we know that overall sum, like I think in this particular case, 4,50,000, that's the total amount. Now this is the amount which comes from your balance sheet. That's why it's called as a book value weight. Now what we do is we write down here what is going to be the weights, multiply that by your after tax cost of capital, and ultimately get your WACC. So the first thing which you have to understand is, will reserves and surplus be part of your balance sheet value weights? Yes sir, no sir. Then the answer is absolutely yes. So always remember that your reserves and surplus will be forming part of your balance sheet value weights. Okay. And in this particular case, what should be your cost of your KE and KR? So my dear students, your KE should always be equal to your KR, but there are some exceptions to it when your KE and KR is going to be different. Okay, because ultimately reserves and surplus belongs to whom? Reserves and surplus actually belongs to the equity shareholders of the company. So are they going to expect something from the reserves and surplus also? Come on, yes or no? Yes sir. So when a company wants to expand, or whenever the company wants to grow, always remember that they are going to take into consideration even retained earnings as the part of the sources of funds. So in that particular case, reserves and surplus will also be taken into consideration as the part of the source. So that's why there will be equity share capital, reserves, preference shares, long-term loans, and this 10% debt. Now whenever I'm talking about reserves and surplus, what should be the after-tax cost of capital of it? So basically your KE should be equal to your KR. Okay. Now when KE and KR, when are the situations when your KE and KR is going to be different? So the situation number one is when KE will not be equal to KR is when there is flotation cost which is given to you in the question. What is given to you in the question? Flotation cost, or I can put it like this, share issue expenses. Because flotation cost or share issue expenses, are we going to take into consideration when we are going to calculate your KE, whenever we are going to calculate your KR? Then the answer is absolutely no. Okay, so let's say for example, they have mentioned in the question that this equity shares were issued, at this much market price, and then there is some 5% flotation cost. So in this particular case, when you are calculating this KE, of course you will be taking in the denominator net proceeds. But my dear students, how is this net proceeds calculated? So from the market price, whenever you subtract flotation cost, what we actually get is called as your net proceeds. But my dear students, when we are calculating KR, then in this particular case, I cannot divide that by net proceeds. I have to divide that with what? Whatever is going to be the market price per share. So for KR calculation, we will divide it with what? Market price per share. For KE calculation, we'll be dividing that with what? Net proceeds. And based on that, your KE and KR will be calculated, and it's very much possible that your KE and KR will be different. Okay. And also, if suppose there is some shareholders personal tax which is given to you. Now in this particular case, whenever you see the word there is shareholders personal tax which is given to you in the question, then your KR will be calculated by taking KE into 1 minus tax rate. Okay, so let's say for example, they tell you that KE is nothing but example 15%, but the shareholders personal tax is explicitly given to you in the question, which is example 30%. So in this particular case, what will be your KR? So that will be 15% into 1 minus, suppose your tax rate is 30%, then based on this you will be getting 10.5%. that will be treated as your KR. So whenever your KE and KR is going to be different, can I say in this particular case, we will be having different KE and KR. So your reserves and surplus will be having book value weights. Come on, yes or no? Yes, sir. Even if suppose your KE and KR are same, in book value weights, your reserves and surplus will always be forming part of it. But whenever we are talking about market value weights, now what is market value weights? Now in this amount column, are we going to write down the market prices of every financial instrument which is available? Come on, yes or no? Then the answer is absolutely yes, right? So we'll be considering the market prices. So let's say for example, we have number of equity shares, and suppose the number of equity shares is nothing but 1 lakh and the market price is 20 rupees. So in your market value weights, will we be considering 20 lakh rupees as your equity share capital? Come on, yes or no? Yes, sir. Now in this market value weights, should you consider reserves and surplus? Then the answer is absolutely no. Okay, reserves and surplus will not be forming part of your market value weights. Now why is that reserves and surplus will not be forming part of the market value weights? Because the market price of equity shares is always after considering the impact of your reserves and surplus. So if a company has a higher reserves and surplus and same number of equity shares, obviously that particular company will have a higher market value of equity as compared to the company in which the reserves and surplus is relatively lower. So always remember that whenever there is market value weights, okay, so your market value of equity is always after considering the impact of your reserves and surplus, and hence reserves and surplus ideally should not be forming part. Again, I'm repeating, reserves and surplus should not be forming part of your market value weights. But when will your reserves and surplus come in your market value weights? That is only and only possible when your KE is not equal to KR. So whenever your KE and KR both are different, will reserves and surplus be forming part of the market value weights? Come on, yes or no? Then the answer is yes, sir. Okay, so it all depends upon what is your cost of equity and cost of reserves and surplus. Okay, so primarily, just to summarize this, can I say in book value weights, will your equity share capital, reserves and surplus, preference shares, debentures, long-term loans, everything will be forming part? Come on, yes or no? Yes, sir. And all these values will be taken from what? From your balance sheet. Okay, and ideally your KE and KR actually should be your same. Okay, then there is going to be KP, then there is going to be KD, and there is going to be KL, which is nothing but cost of long-term loans. So usually this is going to be the normal format. Okay, but when we deal with your market value weights, now in this particular case, we are going to write down the market price of every financial instrument. So equity share capital, we will write down its market price. Then preference share capital, we'll write down its market price. Debentures, we will write down its market price. Long-term loans, your book value itself is your market value. Right, your book value and market value both are going to be the same. So this is going to be your long-term loans. Okay, but my dear students, reserves and surplus ideally should not come in the market value weights. It will only come under one consideration, and that is when your KE is not equal to KR. And when the KE is not equal to KR, so there are two situations I revised. Number one, whenever there is flotation cost which is given to you, then KE will always be calculated by dividing it by net proceeds, and for calculation of KR, we are always going to divide that by the market price. So whenever there is flotation cost, your KE and KR are not going to be the same. And my dear students, when there is shareholders personal tax which is given to you, then for your KR calculation, we will take KE into 1 minus shareholders personal tax, and in both the situations, your KE is not equal to your KR. And then my dear students, in your equity share capital, in such a situation, reserves and surplus can come. So you must be wondering that how do we calculate now this reserves and surplus? So this reserves and surplus can then be calculated by dividing whatever is your equity share, whatever is the market value of equity, into your book value weights. So let's say, for example, your market value of equity, suppose your market value of equity is coming as 20 lakhs. Okay, and here in the book value, equity share capital was example 10 lakh, and this was 5 lakhs. So now this 20 lakh needs to be divided in equity and reserves and surplus in the ratio of 10 lakh and 5 lakh. So that is nothing but 2:1. So that is why 2/3 and 1/3 will be the bifurcation of market value of equity, in which there will be equity share capital and there will be reserves and surplus. Okay, so I am expecting in your examination market value weights questions can be asked, and in market value weights also they can ask you a very challenging question to calculate your KE, KR separately, what should be your KP, what should be your KD, etc. Okay, now my dear students, let us come to the last type of weights, and that is nothing but your marginal value weights. So whenever we are dealing with your marginal value weights, these marginal value weights are also known as additional value weights. Now when this additional value weights will be taken into consideration, so very simple concept, this additional value weights will only and only come when we are going to raise additional finance. Okay, and what should be the cost of only that additional finance? So let's say, for example, you already have your existing capital structure in which you have 10 lakh rupees available, and this 10 lakh rupees, you know, there might be, you know, this 10 lakh rupees might be bearing a cost of, let's say, for example, 7%, but now you are raising additional 5 lakh rupees. Now what should be the cost of this additional 5 lakh rupees is something which we determine on the basis of your marginal value weights. Okay, so marginal value weights, my dear students, we have to take into consideration when the company is raising additional finance. Okay, hi Ishika, how are you? And now there is one more doubt which has been given to you. And what is the doubt? which is being specified, that is split in the ratio of reserves and equity, right? Yes, absolutely correct. So we have to fix this in the ratio of reserves and whatever is going to be your equity. Okay, so then my dear students, let's continue this further. So based on this, we can calculate what can be your book value weights, what can be your market value weights, etc., etc., and we can calculate that accordingly. Now my dear students, as I told you that in this WACC calculations, we have to prepare the tables, and based off this we can use book value weights, market value weights, and marginal value weights to calculate the overall cost of capital. Okay, now I want you to come to some important transactions and important questions which are there, okay, based on which we can do the necessary calculations. Okay, so first now I just want you all to come to your practical questions. Okay, and in this practical questions now I want you all to very quickly come to this particular question, which is actually your question number 5. Okay, now see what is given to you, your question number 5 for study module, that determine the cost of the best luck limited using book value weights and your market value weights using the following information. So are we required to calculate your WACC? Come on, yes or no? Yes sir. And are we required to calculate using book value and market value both? Yes or no? Yes sir. Now what is given to you? You have equity shares, retained earnings, preference shares, debentures. We have the book values, we also have the market values. As you can very rightly see, in your market value, retained earnings is not specifically given to you. Okay, now in this particular case, see what is specified, that equity shares are quoted at 130 and a new issue is priced at 125, which will be fully subscribed. Flotation cost will be ₹5 per share. Now your what is going to be the interpretation? Very simple part, that when we are calculating the KE, are we going to use the net proceeds? Come on, yes or no? Yes sir. But when we'll be calculating KR, then in KR we'll be considering whatever is going to be the market price of the share. Okay, so that is why the KE and KR is going to be different. And whenever your KE and KR both are going to be different, can I put it like this, that we are going to consider in market value weights, equity and reserves both? Come on, yes or no? Yes sir. Okay, now how are we going to do this bifurcation? So as you all can see, the market value is 2 crore rupees. Now this 2 crores will be split into equity and reserves and surplus on the basis of whatever is the book value. So what is the book value? As you all can see, equity is 120 and your retained earnings is 30. So basically this is nothing but 4:1. So that is why, can I put it like this, this is 4/5, this is 1/5. So now when I take 2 crores and divide that by 5, can I say 40 lakhs will be your reserves and surplus, and your equity share capital is going to be 160 lakhs, and based on this the bifurcation will be done. Why? Because your KE and KR both are going to be different. Okay, then my dear students, let's talk about your dividends. When we are calculating KE, now to calculate the KE, my dear students, your past year dividends are definitely given to you, but you don't have year wise dividends. So here we are going to use compound interest formula for the purpose of calculation. Okay, so in this particular case, yeah, so how are we going to take this into consideration? Now see, let's say for example, the dividends in the last year was nothing but 10.6, and now the dividends at the end of 5 years has become 14.19. Okay, so now how do we calculate your cost? See, first of all, to calculate your K, which formula are we going to use? D1 upon P0 into 100 plus G. But because we are talking about new equity shares, so this has to be KE new. So instead of P0, we are going to take net proceeds into 100 plus G. Okay, but for KR calculation, what are we going to do? We'll be taking D1 upon P0 into 100 plus G. This is the ideal formula on the basis of which your KE and KR can be calculated, right? Now, when it comes to your net proceeds, what is going to be your net proceeds? So your net proceeds here, as you all can check, that the new issue is priced at 125 and the flotation cost is 5. So that's why this will be divided by 120 rupees. And when it comes to your KR calculations, I repeat, we have to take market price, and the market price is 130 rupees. So institute in this particular solution, they have taken 125, but in one of the illustrations above, they have given to you 130 rupees. So that is nothing but the market price only. So we have to take into consideration your market price. Okay, so then we'll be dividing that by market price and multiplying that by 100 plus whatever is going to be your growth rate. Now, how do you calculate this growth rate? So this growth rate in this particular question will be calculated by using compound interest formula. So how do you calculate your compound interest formula? That is amount is equal to principal into 1 plus I raised to the power n. Okay, Then at this particular case, what is going to be your principal? So your principal here, as you all can just check, that the dividends have been steadily increased from 10.6 to 14.19. So this is 10.6, this is 14.19, and this will be 1 plus I raised to the power n, and this is nothing but how many number of years? 5 years. So in this particular case, can we calculate what can be the rate? Come on, yes or no? Yes, sir. So now this rate can be calculated with the help of the table which can be given to you in the question. So institute has asked a similar type of a question some 3-4 attempts before, in which they had specifically given to you the value of this particular I, what is going to be, because it's root of 5, which is not possible on your normal calci, until unless you do the steps. Okay, so I'll tell you the steps as well. But if suppose you don't want to waste time there, then sometimes in the question they can give you the value, and based on that we can calculate it. Okay, so here in this particular case, if suppose the factor is given to you, we can simply take that into consideration. If not, then how do we calculate that? So this will be 14.19 and divide that by 10.6. Can this help you to calculate what can be the factor for which the fifth root needs to be calculated? Yes, sir. So that will be 14.19 and I'll divide that by 10.6. So we need to find out 1.3387 and we have to calculate the fifth root of the same. Okay, now in this particular case, if you want to calculate what is going to be the fifth root, so what will you do is we have to take into consideration of 12 times we can take into consideration your root. And then my dear students, when you take 12 times consideration of your root, what you have to do is you have to take -1, divide that by 5, then we have to take +1 and then take square of 5 times. So these are the steps which we have to follow, based on which we can calculate what is going to be your interest rate. Okay, so then with me, if you want, you can practice this. You have 1.3386, you can take 12 time roots. Okay, so that will be 1 2 3 4 5 6 7 8 9 10 11 12, and then what you can do is you can subtract 1 and divide that by 5, and then you can take +1 and then take the square for how many number of times? 12 times. So into is equal to 1 2 3 4 5 6 7 8 9 10 11 and 12. And based on this, if you do, you will be getting the value which will be nothing but 1.06007, and from this if you subtract 1, this will be 0.06, because this 1 will be used for the purpose of subtraction. So this will eventually give you 0.06 or ultimately 6%. So in that particular case, will your growth rate be taken into consideration as your 6%? Come on, yes or no? Yes, sir. So this is going to be your 6%. Now what is going to be your D1? So can I say your D1 is now going to be whatever was your last year's dividend, and to that we have to add the growth rate. So as you all can check that you had your last year dividend, which was nothing but 14.19. So what we need to do is we will be taking 14.19 and then to this 14.19 I'll be adding the growth rate of 6%. So 14.19 add 6%, and this will eventually give you 15.04. So always remember that whenever they use the word expected dividend or next year's dividend, so definitely we are going to consider that as D1. But if it is last year's dividend, then don't you think we have to add the growth rate to it to get your next year's dividend? Come on, yes or no? Yes, sir. Okay, I'm really liking the way you all are answering the questions. Please keep on answering this in the chat box. So that is very, very, very important. Okay, and also at the same time here also it will be 15.04, and based on that we can calculate your KE and you can calculate your KR. Okay, so this was the crux of a very important question. But along with this, they have also specified this transaction is also important, where it is mentioned that the company proposes to issue 11-year 15% debentures. Okay, but yield on this debentures of similar maturity in the risk class is 16%, and when there is flotation cost which is 2%. Now how do we crack this particular question? Okay, so how are we going to crack this question, this part of the transaction? So always remember, my dear students, that whenever we are required to calculate your KD, okay, now to calculate the KD here in this particular case, first of all, what is the life of the debentures which is given to you? The life of the debentures which is given to you, that is 11 years. So in this particular case, we have to calculate by taking interest into 1 minus tax, plus what is going to be your redemption value minus net proceeds. We divide that by n, and then we are going to divide this with what? Redemption value plus net proceeds upon 2 into 100. Correct? This is the formula which we are going to use. Okay, now my dear students, your interest is always calculated on the face value. So you have 15% debenture, and Here what is going to be your face value? So face value, no information is given to you, we will consider that as 100 rupees. So now your interest will be 100 rupees multiplied that by 15%, so that will be 15 into 1 minus whatever is your tax rate. Suppose your tax rate which is given to you in the question is 35%, and then we will be taking into consideration whatever is your redemption value. If no data is given to you, then your redemption value will be treated at par. But now the question arises, life is 11 years, what is going to be your net proceeds? Now to solve this kind of a question, how will we calculate your net proceeds? So to calculate the net proceeds, my dear students, we are going to use, what are the similar type of debentures offering. Now in this question it is specified that yield on similar debentures on similar maturity and the risk class is 16%. So now it's a very simple concept that your similar type of debentures or your competitors, they are actually issuing the bonds or debentures of the face value 100 rupees and they are offering 16% rate. They are offering 16% rate. Okay. Now in this particular case, if you are offering 15% rate, who will buy the debentures from you? There is no one who's going to buy the debentures from you. For someone to buy the debentures from you, it is important that you give them equivalent return. So on 100 rupees, 16 is the interest which is being provided. So if you are providing 15 rupees, then what should be your issue price? So if you calculate like this will be 15 into 100 and we divide that by 16. So that is nothing but rupees 93.75. So can I put it like this, that your issue price should be nothing but 93.75? Come on, yes or no, sir? Yes, sir, this should be 93.75. But here, can I put it like this, that there is some kind of flotation cost also which is given to you? So this flotation cost which is given to you, that is nothing but 2%. So this 2% is to be calculated on the face value which is specified here, or else this 2% flotation cost, if no data is given to you, can be subtracted from the market price. Come on, yes or no? Yes, sir. So all these important points, you can make a note of it, that whenever the flotation cost percentage is given to you, this flotation cost can be applied to market price per share, or it can be applied to whatever is the face value. But if no data is given to you, then we prefer market price per share. But if suppose specifically they have given to you, then from this 93.75, we are going to subtract the flotation cost of 2% of rupees 100. So that is why 2 rupees will be subtracted and eventually 91.75. This is going to be your net proceeds. Okay. I hope you guys are understanding. So your net proceeds is now going to be 91.75. So this question had these two important transactions which you have to understand it. Okay. Now, my dear students, I am going to start with something which is called as your, YTM approach for the purpose of calculation. Now, this YTM approach, I am revising, before your investment decisions. Why? Because YTM, first of all, actually has the concept of IRR in it. Okay. So apparently what happens is that whenever we are dealing with your yield to maturity. Now what is yield to maturity? Can I put it like this? This yield to maturity is nothing but actually your effective yield, or the returns which an investor is going to earn if the investment is made over a particular period of time. Okay. So let's say, for example, you are buying the debentures today and holding it towards its maturity. So what is the effective yield which you are going to earn? So that is nothing but your yield to maturity. Now you must be wondering, sir, in cost of capital chapter, why are we studying yield to maturity? Because it's a very simple concept that whatever is the yield or return for an investor, that itself is nothing but the cost for the company. So whatever is your yield, that is nothing but my cost, right? So yield to maturity, if I know how to calculate it, indirectly, I actually know what should be the cost of capital for the company. Correct? So now this yield to maturity is actually calculated with the help of your IRR, internal rate of return. And what is your internal rate of return? It is the rate at which your PV of CI is equal to your PV of CO. Okay, so present value of cash inflow should be equal to present value of cash outflow. So just imagine a situation like this, that let's say, for example, a particular investor has subscribed to the bonds of the company at market price. So in that particular case, can I say market price of the debenture should be taken into consideration? Yes. So suppose your market price of the debenture is, let's say, for example, 95. So now in this particular case, can I say that an investor has actually spent from his pocket 95 rupees, and now the investor is going to get over the period of 5 years some cash inflows. and that cash inflows is going to be in the form of your interest. So just imagine a situation like this, where we have year 1, year 2, year 3, year 4, year 5, we have the interest, okay? And suppose the interest is, let's say for example, 10 rupees. So this 10 rupees is nothing but the interest which an investor is going to get. But on this, suppose the tax rate which is given to you, that is 30%. So don't you think in this particular case, we have to calculate this post tax? So that's why we'll be having finally 7 rupees as your post tax interest cost. And then at the end of the 5th year, are we going to have any redemption value? Come on, yes or no? Yes sir. Suppose your redemption value available is, let's say for example, 105 rupees. Now all these are your series of cash inflows. Now what we have to do is we have to discount it at a rate in such a way that the present value here should be understood as 95 rupees. So when the present value comes here as 95 rupees, what does it mean? That this particular rate is nothing but your IRR, because your PV of CI matches with the PV of CO. But I hope you all know it cannot be calculated directly like this. So we have to use your trial and error method. So in trial and error method, what do? Is we prepare a range in which there should be one PV of CI which should be greater than PV of CO. There should be one PV of CI which should be less than the PV of CO. And ultimately what are we going to do is we'll be using the concept of your discounting factor and interpolation, on the basis of which your YTM can be calculated. Okay, so I am expecting that a question like YTM can be asked in the examination. Okay, and it is extremely important. So from the examination perspective, so that is why now I'll be revising this particular question, that is your question number 17. Now in this particular question also, see what is given to you, that you are required to calculate the WACC using the following data by using book value weights and by using market value weights. Now as you all can just check, here the capital structure of the company is given to you. Now whenever the capital structure of the company is given to you, always remember that this capital structure is always your book value weights. Okay, so we have debentures of 5 lakh, face value of rupees 100 per debenture. So in this particular case, what is the number of debentures we have? We have 5,000 number of debentures. Preference shares is 5 lakh, face value is 100 rupees, so this is nothing but 5,000 preference shares. Equity shares of 10 lakh and face value is 10 rupees, so that is nothing but 1 lakh equity shares, correct? So these are the number of equity shares. Now why is this important? Because whenever we have to calculate market value weights, don't you think we are going to take these financial instruments and multiply that by the market price? So eventually we'll be getting the market value weights. Okay, now in this question, see what is given to you. Rupees 100 per debenture redeemable at par, 10% coupon rate. Can I say coupon rate is nothing but your interest rate? 4% is your flotation cost. Now this flotation cost, as you can see, it is not mentioned that it should be applied on face value. So in that particular case, are we going to take into consideration your flotation cost as a percentage of your market price per share? Come on, yes or no? Yes sir. So I'm revising both the types of concepts. In that particular question, it was specifically given to you that the flotation cost is a percentage on your face value. In this particular case, the flotation cost is actually a percentage on market price. So we have your debentures, which is 105. So how will you calculate your net proceeds, guys? So your net proceeds will now be 105 minus your 4%. So that will be nothing but 100.8. Can I say 100.8? That will be treated as your net proceeds. Come on, yes or no? Yes, sir. So for a company, the debenture holder has actually paid 100.8. Matlab the company is receiving net 100.8. Now, when we are going to deal with your YTM approach, you have to understand that an investor is going to find out a discounting factor at which your PV of CI should be equal to 100.8. And how is he going to do it? He is going to do it with the help of your trial and error method. Okay, so first I'll give you one trick. What is to be done in your examination? So Ishika, whenever in the examination you get such kind of a question, what we need to do is first we have to calculate your KD. So you calculate KD. Though they have told you that you are required to calculate the cost using YTM method, still I am telling you calculate the KD by using your approximate method. What is the meaning of the word approximate method? Approximate method means by using the formula. So what will be the formula? Your KD will be what? Interest into 1 minus tax. So whatever is your 100 rupees, 10% is the coupon rate. So 10 into 1 minus, what's the tax rate given to you? 0.3 plus what is the redemption value? Then the redemption is at par, so that's 100 minus what's the flotation cost? So your flotation cost is 100, net proceeds is 100.8 and the life is nothing but 10 years. And this is something which I'll divide by 100 plus 100.8, divide that by 2 into 100. So I'll be getting some KD. Now whatever KD I've got now, this KD can help me to establish a range for the purpose of calculation of YTM. So that's why, my dear students, whenever you see that you are required to calculate your KD, then this KD, my dear students, will always and always be calculated by using your YTM approach, and you can calculate it accordingly. Okay, so that is first calculate by the way of the formula. You get the percentage, and once the percentage is described, then we can do, you know, a range and do the calculation accordingly. Okay, same happens for your preference shares as well. And equity shares, now see the word, the expected dividend is given to you. So whenever the word expected dividend is given to you, are you going to add any growth rate to it? No, this itself is your D1. Growth is given to you, and we are required to calculate what should be your K. Here, my dear students, as you all can see that the range which we have to take is 5% and 7%, and the objective is actually to get your net proceeds, which is nothing but, for in case of your debt, you know, it is 105 is the market price. So 105 minus your 4% of 105. So what is 4% of 105? As we have discussed, it's nothing but 100.8. So this is nothing but 100.8, and we have to focus on this 100.8. So we want to get this 100.8 by using trial and error method. So based on this, we'll be getting it. Okay, so Ishika has already calculated that your KD is coming at 6.89%. Now can I say, very good, that your KD is coming at 6.89%. So basically you have to create a range in which you can take 5%, 10%, and then lower the range which you take, better it is. And based on that, you will be able to get your KD using your YTM approach. So in your YTM approach, the first step is, you know what, I would prefer that you should take into consideration KD by using the formula. And once you get the KD, we get the range available. And once the range is available, based on that, we have to take into consideration what is going to be your KD by using your trial and error method, by using, you know, that one particular percentage is greater, one is less, and then based on that, we can calculate your KD. Okay, so I wanted you all to understand the concept of YTM, so that's why I've revised this particular question as well, and I've told you the trick that what can be done. Okay, also market price should be taken into consideration. Okay, now my dear students, there are some questions which I want you all to understand pertaining to, you know, realized yield approaches. Okay, so basically, see, I've taught you what is going to be your KD, KE, KP, etc., and how do we use WACC using book value weights, market value weights, and the tricky points in your book value and market value. We have discussed that. Okay, now my dear students, I want you all to understand something pertaining to your you know, realized yield approach. Now what is this? Just pay attention. Okay, I'm expecting this kind of questions can also be asked in your cost of capital, because you know, YTM method, IRR method, you know, this KD, apart from the conventional formulas, by using this discounting factors, based on that also they can ask you the question. So do practice this. Okay, now before we proceed further, you know, if you want to calculate the growth rate, now how do you calculate the growth rate, my dear students? Now to calculate the growth rate, what we need to take into consideration, so please pay attention to this, that whenever there is growth rate which is given to you in the question, then it's fine. But if the growth rate is not given to you, then in that particular case, we have to use the concept of either past year dividends will be given to you, or the retention and ROE will be given to you. Now, when the past year dividends are given to you, how do you calculate your growth rate? So when the past year dividends are given to you, you calculate the growth rate in a very simple way, and that is nothing but you check. Suppose this is 10, this is 11, this is 12.1. So this will be 10%, this will be 10%. So you'll assume that the growth rate is 10%. But suppose sometimes this is 10, this is 11, this is 15, this is 14, this is 16, something like that. So there are different levels of growth rate. In this particular case, you can use the average method also to calculate your growth rate. Okay, but then my dear students, what is this retention? What is this retention? Okay, so you have to pay attention to this, that now when retention and ROE is given to you, how are we going to do the calculations? Okay, so everyone please tell me that whenever a retention rate is given to you, so what is retention rate? 1 minus dividend payout rate. So that will give you a retention rate, and this retention we are going to multiply that by whatever is your return on equity. Suppose you are paying off dividend which is 40%. So in this particular case, your retention is 0.6. We have to check that where this retention is being reinvested. And suppose we are reinvesting those retentions at, let's say, 10% rate, then can I say your growth rate will be treated as your 6%? Come on, yes or no? Then the answer is yes, sir. So retention into ROE, will that also give you your growth rate? Come on, yes or no? Yes, sir. Okay, so this is how your growth rate can also be calculated. Okay, now What is this realized yield approach? So basically, realized yield approach, in these type of questions, we are going to use the concept of IRR only, or the discounting factor, for the purpose of calculation of your returns. Now let's say, for example, if I tell you that, you know, I have invested in a particular bond for rupees 1000. Okay, so can I put it like this, that my PV of CO is nothing but 1000 rupees? Come on, yes or no? Then the answer is yes. So I am actually spending 1000 rupees. So I've purchased a bond for 1000 rupees. Now over the period of, let's say for example, 5 years, I'm going to receive some interest. Suppose interest is 100 rupees, 100 rupees, 100 rupees. And then towards the end, for example, the redemption value is 1000. So overall my cash inflow is 1100. Now what we have to do is, we have to discount this at a particular percentage in such a way that my present value of cash inflow should be equal to present value of cash outflow. So don't be afraid if in the examination they give you that you know, you are required to do the calculation based on realized yield approach. So when we are talking about realized yield approach, what we need to do is, very simply, we'll be taking all these particular cash flows, discount it and bring it to the present value terms, and this present value terms will be treated as your PV of CI. If this PV of and CI and PV of CO is same, so this discounting factor is called as your realized yield. That is the returns which is getting generated. So it reminds you of your IRR. Okay, so the same concept is applicable here. Okay, now see what is given to you. Mr. Mehra had purchased a share of Alpha for rupees 1000 and he received a dividend for a period of 5 years at the rate of 10%, and at the end of the 5th year he sold the shares of Alpha for 1128. You are required to calculate the KE using realized yield. Now just check what's your PV of CO. Your PV of CO is 1000 rupees. Now think from the investor's perspective, over the period of 5 years, is this particular investor going to get some returns? Come on, yes or no? Yes, sir. So over the period of 5 years, the dividends received will be, can I say 100, 100, 100, 100, 100. Okay, so this is nothing but the dividend which will be received. And at the end, can I say the shares will be sold? So 1128, this is nothing but the market price. So all these are your future value of cash inflows. What we need to do, we have to discount it at a particular percentage in such a way that the present value should be 1000. Now, how will you know what should be your discounting factor? So in this particular case, we have to actually create a range somewhere of 10%, 15%, something like that. But your institute has directly done at 12% rate, but you can do it by 10%, 12%, find out what is the range, and based on that IRR can be calculated. Okay. So this is one of the questions which I wanted you all to understand it. Okay. Similar to that, okay, we will also do one question. Okay. So what is the doubt? The doubt is, how are we getting 12%? Now see, this 12% now ICF just assumed it in this particular question. Okay, but here we have to always create a range. We have to take 10%, 15%, create a range, and based on that you will be getting your 12% rate. Okay, so that is something which you have to understand, that we cannot take into consideration directly 12%. We don't know. Okay, but institute, you know, these guys are they have foresightedness in such a way that they can directly take 1% and at that PV of CO will come. But that is not going to happen in real life. So you will be creating a range, and based on that you have to calculate what should be your realized yield. Okay, got it? Now, as I was telling you, see, in this particular question, the market price is given to you as your 200 rupees. Okay, and then we are issuing it at 190 and the flotation cost is 5 rupees. So as I told you that we are going to take into consideration you know, whatever is your 200 and 190 minus 5, and based on that we'll be calculating the two cost percentages. Okay, so now my dear students, let us continue this further. Okay. Parth, okay, I was just expecting you to be in the stream as well. Okay, fine, absolutely perfect, great, amazing. Chalo, now there is book value weights and then there is market value weights, based on which we have to do the necessary calculations. Okay, now let's continue this further. So realized yield approach basically means what? Your YTM, and based on that we have to do the necessary calculations. Okay, now marginal value weights. Now this is one of the questions which I want you all to understand, and which is pertaining to your optimum capital structure. Now see, whenever we are dealing with your marginal value weights, how are we going to do the calculation of marginal value weights? Now see, just pay attention. Okay, marginal value weights. Now marginal value weights is also called as your additional value weights. This is also known as your additional value weights. Okay, additional value weights. Now my dear students, Parth, pay attention. how do we calculate on the basis of additional value? See, basically, if they give you in the question that the funds required is 10 lakhs, and in this funds required 10 lakhs, suppose they tell you that the retained earnings available with you is for example, it is available as 2 lakh rupees. Okay. Now they tell you that the company has to maintain a debt equity ratio of, let's say for example, 30% of debt, example 70% of debt and 30% of equity. Now how are we going to prepare your breakup of the cost? So in this particular case, see, the total funds required is 10 lakh rupees. Now this 10 lakh rupees we have to divide into two parts, and that's your debt and equity. So what is the proportion of debt? So your proportion of debt is 70%. What is the proportion of equity? That is nothing but 30%. Now this 30% of equity will have some reserves and surplus in it. So what is the reserves and surplus which the company already has? It has 2 lakh rupees available. So 2 lakh will be treated as your reserves and surplus. So can I say the balancing part will be treated as your equity shares, and that will be nothing but what? 10 lakh equity is 30%, that is 3 lakh rupees, and your 7 lakh will be treated as your debt, and in this 3 lakh rupees your reserves is 2 lakhs. So obviously your equity share capital will be how much? 1 lakh rupees. So this is what the pattern of raising additional finance. So we have one of the questions in a study module in which they have told you that how do we calculate market value weights. So this market value weights on the base of pattern of additional finance can be calculated like this, where we have debt, equity available, then we have debt proportion 70, equity is 30, and when we have equity 30, then we have reserves and equity share capital both in it. And in this particular case, suppose your reserves amount is 2 lakhs, can I say your equity share capital will be your balancing part, that is nothing but 1 lakh rupees, and debt will also have some different proportions. So basically in marginal value weights we will be having this particular pattern of raising additional finance. Okay, this is one basic part on the basis of which marginal value weights can be calculated. But my dear students, sometimes they will not give you this pattern of raising additional finance. Rather, you know what they will give you? They will give you that the company follows an optimum capital structure. Now, what do we mean by the optimum capital structure? So my dear students, whenever we are talking about the optimum capital structure, here the first most important point is that we have to check what is the existing capital structure. Suppose we have existing capital structure in which there is 14% debt which is given to you, then there is 11% preference shares which is given to you, and then there is your equity shares which is given to you. Okay, now what is your debt, preference and equity shares? Suppose your debt is 30,000. Your 11% preference shares which is given to you, that is nothing but 10,000. And then my dear students, we have the equity which is given to you, that is 1,60,000. So this overall tells you that the total amount available with you is 2 lakh rupees. Now how is this 2 lakh rupees raised? Then 0.8 is your equity, then 0.05 that's your preference shares, and 0.15 that is your debentures. So can I put it like this, that these weights are going to be constant? Come on, yes or no? Yes sir, these are your optimum weights. Now any single rupee additionally which will be raised by the company has to be raised compulsory in this particular weights. So what you have to understand here is, let's say for example the company needs 5 lakh rupees. So how are we going to raise this 5 lakh rupees? So this 5 lakh rupees will be raised in this particular weights only, where there is 14% debt. Now this percentage of debt can be anything else, so it can be 16%, 18%, 10%, whatever, but there is going to be debt, there is going to be preference shares, there is going to be equity as well, and then the weights will be given to you 0.15, 0.05 and 0.8. we just have to multiply that by individual cost, and then we'll be getting the WACC. So remember something like this, that whenever we have optimum weights, is the company following optimum weights throughout? Come on, yes or no? Then the answer is absolutely yes, and this optimum weights will be taken into consideration in future as well. Okay, so in this particular question we were required to calculate what's the cost of new debt, what's the cost of new preferences, what's the cost of new equity, which is in the form of retained earnings. So basically reserves and surplus. Okay, so then we can take into consideration retained earnings also as the part of the source of finance. So that was the basic thing, but here it was specific cost of capital. Now they have asked you what is marginal cost of capital, but they have not specified the weights. But in the question you all can just check that do we have this amounts which is optimum given to you? Come on, yes or no? Yes sir. So we have this optimum weights available, and we can take this weights and multiply that by the specific cost. We'll be getting your weighted average cost of capital. Okay, now this C part is important. Determine the amount that can be spent for capital investment before new ordinary shares must be sold. So before new ordinary shares must be sold, what is the meaning of this? That before we are issuing new equity shares. Now before we are issuing new equity shares, can reserves and surplus be part of equity from which expansion can be done? Come on, yes or no? Yes, sir. And how much are we keeping by the way of reserves and surplus? So if you just read this particular statement, it is specified that assuming that retained earnings for the next year's investment is 50% of 2022's earnings. So here you can just check that 2022 EPS is 2.36. So you take through 2.36 and multiply that by 50%. So 1.18. Can I say that is the dividend which is supposed to be distributed? Or else we can call this that this is nothing but retained earnings, which we multiplied by the number of equity shares, which is nothing but 10,000. So can I say 11,800 is your reserves and surplus, which can be available for the purpose of expansion and growth. Okay, so we have this 11,800 for the purpose of expansion and growth. Okay, now in this particular case, if I have the weights available, can I put it like this, that equity is 0.8 and the amount is 11,800. Can I find out what's the total amount which I can raise it? Come on, yes or no? Yes, sir. So if 0.8 is nothing but 11,800, then this one should be how much? So this should be 11,800, divide that by 0.8, which will be nothing but 14,750. So this 14,750, can I say this will be raised by the company without issuing new equity shares? Come on, yes or no? Yes, sir. But if you want to raise more amount than 14,750, then new issue is mandatory. Okay. So with this, my dear students, we can put an end to this particular chapter, which is your cost of capital. Okay, so I hope you all have understood how do we take into consideration cost of capital, what are the formulas which are involved in it, what is specific cost, book value weights, market value weights, margin value weights, YTM, then realized yield approach. All these things we have calculated. One more important thing which I want you to understand is your convertible debentures. Okay, so that is something which I want you all to understand. Now okay, this is the last thing, and after this after this convertible debentures, this entire concept of all the important things pertaining to your cost of capital gets completed. Okay, so let us first discuss what is going to be your what is going to be your convertible debentures. Okay, so let us understand that. Convertible debentures, let me just make you understand. Okay, like this, see. This particular question number 7. Okay, now see what is given to you in your question number 7. Okay, everyone, eyes on the screen, please. Okay, pay attention. This is very important. Now see what is given to you. A company issues 15% convertible debentures of ₹100 each at par with a maturity period of 6 years. Okay, now on maturity, each debenture will be converted into 2 equity shares of the company. And after which they have specified that the risk-free rate of return is 10% and the market premium is 18% and the beta is 1.25. The company pays a dividend of 12.76 and 5 years ago it paid a dividend of ₹10 and the flotation cost is 5% of the issue amount. Now based on this, we are required to calculate what should be your KD. So my dear students, how do you calculate your KD? So very important point here is that first of all, these are convertible debentures. So you can't expect redemption amount here. So you have to find out what should be the convertible amount. Now these debentures, are they getting converted into equity shares? Come on, yes or no? Then the answer is absolutely yes. And it is specified that each debenture will be converted into 2 equity shares. So one debentures will have 2 equity shares. Okay. So now my dear students, if I have what is the market price of equity share, then of course I can find out what should be your convertible value. Okay, so just listen to this. What is given to you, that the company has paid a dividend of this and 5 years ago it paid a dividend of ₹10 per share and the flotation cost was nothing but 5%. See my dear students, whenever we want to find out that what should be the price available on conversion, we should know what is the market price available. Now see, here they have told you to use approximation method. Whenever they use the word approximation method, what do? We take into consideration your formula, which is KD is equal to interest into 1 minus tax plus, instead of redemption value, what am I going to take into consideration? Convertible value minus net proceeds upon N, and we are going to divide this with whatever is your convertible value plus net proceeds upon 2 into 100. Okay, so this is how we are going to do the calculation. Now see, just check this out here. On maturity, each debenture, okay, first of all, this maturity period is 6 years, and on maturity, each debenture will be converted into 6 equity shares. So it's a very simple concept that for one debenture, you are going to get equity shares too. When? Then this will be received at the end of which year? At the end of 6th year. Okay, so apparently what do we need is, we need what should be the market price of equity share. Okay, and we need market price of equity share today or at the end of the 6th year. At the end of 6th year, only then we can multiply that by 2 and determine what should be your conversion value. Okay, now the risk-free rate is given to you, market risk premium and beta. Can I say this data is sufficient for you to calculate your KE? So how will you calculate your KE? You'll be taking RF plus whatever is your RM minus RF, and you're going to multiply that by beta. So what's your risk-free rate? Your risk-free rate is nothing but 10%. What is RM minus RF? So RM minus RF is nothing but market risk premium, that is nothing but 18%, which I will multiply by the beta, and the beta which is given to you, that is nothing but 1.25. So is this data sufficient for you to calculate your KE? Come on, yes or no? Yes. So 18 into 1.25 and plus 10 will eventually give you, is this your market risk premium? Yes, 18. Okay, so your K is coming as nothing but how much is it coming? 32.5%. So this is your K. So this will be coming as 32.5%. Okay, now once your K is calculated, what we need to do is, we can find out the price at the end of the 6th year. Now how do you calculate the price at the end of the 6th year? So price at the end of the 6th year can be calculated by taking D7 upon KE minus G, when your growth rate is going to remain constant. So that is D7 upon KE minus G. That's how we are required to calculate the price at the end of the 6th year. Now in this particular case, have I got the KE? Yes, 32.5. Do I have the growth rate which is given to you in the question? So in this particular case, growth rate is not given to you in the question, but we can use this compound interest formula to calculate the same. So something which I just explained to you. So we can use in this particular case, the growth rate is nothing but 5%. So now what will be your dividends at the end of the 7th year? So your last dividend was 12.76, and this 12.76, you have to multiply that by 1.05 raised to the power 7. So you will come to know what is going to be your D7. And once we get the D7, we have the growth rate, we have the K, we can find out the price at the end of the 6th year and multiply that by 2 to get the redemption value, which is also known as your conversion value. Okay, so convertible debentures, I want you to understand this very thoroughly, that whenever the debentures are getting converted into equity shares, it is important for you to first understand what is your conversion value. So for that, you should know what is the market price of an equity share, and market price of an equity share you should know at the end of nth year. So in that particular case, you can use your Gordon's model for the purpose of calculation of what should be the market price at the end of the nth year. Okay, so we can do the calculations, and accordingly we can get what is going to be a D7, and then we can take D7 upon KE minus G, and that's how the calculation will be done for the price at the end of the 6th year. Okay, so do refer to this question as well when you are revising it. So this was pertaining to your cost of capital. Okay, now everything gets completed comprehensively. Okay, now my dear students, let us do something which is pertaining to your capital structure. Okay, now whenever we are dealing with your capital structure, this particular chapter has two main parts. Okay, so this capital structure has two main parts. So the first part of capital structure is what? That we select a financial plan. So selection of a financial plan, that is first part. Then we have something which is called as your, after selection of a financial plan, we have something which is called as your indifference point, and after indifference point we have something which is called as financial break-even point. I hope you all are aware about this. So we are going to learn how do we select the financial plan, what is the indifference point, and what is going to be the financial break-even point. But also at the same time, my dear students, we have the second important part in your capital structure, and that is pertaining to what is going to be your capital structure theories. So this capital structure theories plays a very important role, and we can expect a question on capital structure theories even in your examinations. Okay, now first I will revise quickly what is the selection of financial plan, IDP and FBP. Okay, the questions of which are very much manageable and you can practice this. Okay, one of the tough questions which is there in the study module, I'll tell you, you can refer to that as well. But first of all, how do you select a particular financial plan? So let's say for example, the company already has 10 lakh rupees available with them. Now we need, let's say for example, 5 lakh rupees. So now this 5 lakh rupees which we need, are we going to raise only from one proposal or multiple proposals? Then the answer is multiple proposals. Okay, so this 5 lakh rupees we can raise it by taking into consideration various financial plans. So let's say for example, there is plan 1, plan 2, plan 3 where there are different combinations. Suppose there is equity, there is debt equity, there is preference shares, you know. Suppose in plan 1, let's say for example the equity amount is entirely 5 lakh, no debt and preference shares. In the second plan we are taking 2.5 lakhs by the way of equity, we are taking 2.5 lakhs by the way of debt. In suppose third plan we are taking equity and there is preference shares. So based on that we are raising. So this is called as, yes, absolutely correct, summary of financial plan. So once we have the summary of financial plan, we know that how this particular amount needs to be raised. Okay, so suppose we need to raise this 5 lakh rupees, then we have to take into consideration what is going to be your number of equity shares. Now what will be your number of equity shares? So for number of equity shares we have to divide it by your issue price. Okay, so whatever is the issue price, we have to take that into consideration. So let's say for example the market price which is given to you, that is nothing but 50 rupees. So then we will be taking 5 lakhs and dividing that by 50 to understand that 10,000 shares will be issued here. But we also need to check whether the existing capital structure had some old equity shares or not. So whatever was the old equity shares, we'll add it to it and then ultimately we'll be getting the total number of equity shares. Similarly for plan 2 we'll be having some number of equity shares here as well. Okay, and then old plus new we have to take into consideration, and same goes with your plan 3 as well. Now for the purpose of selection of a financial plan, the first and the most important thing which is required is nothing but what should be your EBIT, what should be your expected earnings before interest and tax, what should be your profits which can be generated. So in this particular case, suppose the EBIT is given to you, nothing like it. Okay, but if they have not given to you, they might give you return on capital employed or some other data on the basis of which you can calculate your EBIT. Sometimes sales can be given to you. From sales you subtract variable cost, contribution, fixed cost, then we get the EBIT, and then from that we subtract interest, TBT, etc. And that can also be one of the ways. Okay, so here my dear students, it is very important for us to first understand that what should be your EBIT. Okay, so in this particular case, suppose we have your EBIT of let's say 2 lakh rupees. Okay, so for all the 3 plans will the EBIT be the same? Yes. From EBIT what do? You subtract the interest. But when you are subtracting the interest, just make sure that whether there is any existing interest or not, and whether there is any new issue interest or not, and based on that we'll be getting your EBT, from which we'll be subtracting tax, we'll be getting your NPAT, and then from this we'll be subtracting the preference dividend, which can be a combination of old and new. Ultimately we'll be getting the net profits for equity shareholders, and then my dear students we can divide that by number of equity shares to get the EPS. So first part is selection of a financial plan. Then my dear students, this selection of financial plan is not necessarily, it can only happen based on EPS. Can I say it can also happen based on your market price per share? So if the PE ratio is given to you, this EPS, if I multiply that by the PE ratio, will I be getting the market price of an equity share? Come on, yes or no? Then the answer is absolutely yes. And we will select a financial plan in which the MPS should always be higher the better. Okay, so this is selection of a financial plan. Then my dear students, we have something which is called as indifference point. Now in your indifference point, the one of the most foremost thing you have to understand is this is that level of your EBIT at which your EPS is going to be the same. So is your EPS of plan 1 going to be equal to your EPS of plan 2? Come on, yes or no? Yes sir, both the EPS is going to be the same. And how do we calculate that? So we calculate that with the help of the formula, which is EBIT minus interest. We multiply that by 1 minus tax, we subtract preference dividend, we divide that by number of equity shares, and then my dear student, this should be equal to your EBIT minus interest into 1 minus tax minus preference dividend, and we divide that by number of equity shares. So let your EBIT be X, and based on that we calculate your indifference point, that level of EBIT in which your EPS is going to be the same. So you are at indifference point, you are okay with plan 1 as well as you are okay with plan 2. Any one of the things are okay. Okay, so that is why we call this as your indifference point. Okay, and then my dear students, once we get the indifference point, what is the next thing which we do is we can also calculate what can be your financial break-even point. Now what is financial break-even point? It is that level of your EBIT. So what is financial break-even point? It is that level of your EBIT at which your EPS is 0. Okay, so understand that indifference point was that level of EBIT at which your EPS was same. Financial break-even point is that level of your EBIT at which your EPS is going to be 0. So understand a situation like this, that when you want to calculate your FBP, it's a break-even point, right? So that's why EPS has to be 0, no profit, no loss. Okay, so how much you have to earn at least to get what should be your minimum return? So that is why we take into consideration what is going to be your EPS. So financial break-even point ideally will be having whatever is your interest plus preference dividend and divide that by 1 minus tax. So are we going to take into consideration PD interest plus PD upon 1 minus tax? Come on, yes or no? Yes, sir. So this will ideally give you what is your financial break-even point. It is that level of your EBIT at which your EPS is going to be your 0. Okay. Now, company has to compulsory earn at least this much amount of EBIT. If the company earns EBIT which is lesser than your financial break-even point, then can I say that the EPS turns out to be negative? Come on, yes or no? Yes, sir. So that is why financial break-even point, that is the least amount which you have to earn. And higher the financial break-even point, higher is going to be your risk. Now, the most important part is what is going to be the relationship? What is the relationship between your EBIT, indifference point, and your financial break-even point? So what is going to be your relationship between these three? Okay. Now for that, I just want you to understand that whenever we are going to deal with your EBIT, suppose your EBIT is greater than your indifference point. So you are earning a profit which is greater than your indifference point, then always select a plan in which your FBP is going to be higher. If your EBIT is less than the indifference point, then always select the plan in which your FBP is lower. So when you do that, can I say here the EPS will rise? Come on, yes or no? Yes, sir. And whenever your EBIT is less than indifference point, then your EPS will also rise when your earnings is less than whatever is your indifference point. Okay. But when, my dear students, your EBIT is equal to indifference point, can I say we can select any particular plan? Come on, yes or no? Yes, sir. So this relationship is very important where we take into consideration EBIT and we compare that with indifference point, and based on that we get the necessary answers. Okay. Now, along with this, my dear students, along with this relationship, okay, in which there is EBIT indifference point, EBIT indifference point, and EBIT is equal to indifference point, then based on this we have calculated your financial break-even point. Now the most important part here is to understand that where the risk is higher. Can I say that when the financial break-even point is higher, the risk is going to be higher? So we will select the plan in which your FBP is higher only when your earnings is more than the indifference point. But if your earnings is less than the indifference point, then select a plan in which the risk is lower. That will give you your higher EPS. Okay. So this is something which you have to understand by the way of relationship. Now in your capital structure, as I told you, the first part is what? Selection of financial plan, which can be either on the base of EPS or it can be on the base of MPS. Second, it is what? We can calculate, apart from the selection, was your indifference point. It is that level of EBIT in which EPS is same. And third is your financial break-even point. It is that level of your EBIT in which your EPS is going to be what? 0. Okay. So that is the minimum which you have to earn. And then we compare these three levels to understand that, which plan is going to be better. Okay. Now, in capital structure chapter which we are going to do, okay, there are some very, very, very important concepts which I want you all to understand first. Okay. So basically we are first dealing with your EBIT EPS part. Okay. Sometimes they can also ask you slab rate interest, and based on that we have to do the necessary calculations. Okay. But remember that the new shares will always and always be issued at what? It will always be issued at the market price. Okay. Now this is one of the questions which I want you to understand. This question number 14. See what is given to you, that the following data are presented in respect of Quality Automation Limited, in which we have EBIT which is given to you. Then there is interest. Then there is EBT, tax, NPAT, number of equity shares, EPS, P ratio, market price. Now all this is your existing capital structure, existing income statement which is given to you. And now the company is planning to start a new project requiring a total capital outlay of rupees 40 lakh rupees. Now can I say this statement is sufficient for you to understand it's a question on capital structure? We need 40 lakh rupees. Okay. Now you are informed that a debt equity ratio, which is debt upon debt plus equity, if it is higher than 35%, it pushes the KE up to 12.5. It means that it is reducing the PE ratio to 8. Now how do we calculate this? So always remember that your KE can be calculated by taking EPS upon MPS into 100. That's how we calculate your KE. Okay. So that is using earning yield approach. So if I take the EPS here, can I say my KE can also be 1 divided by MPS by EPS? So what is 1 divided by MPS by EPS? So that is PE ratio. So can I say my KE can also be 1 divided by PE ratio, or else my PE ratio can be what? 1 divided by KE. and that can be the basis on which we can determine the P ratios. Here they have told you that if the debt equity ratio, and here pay careful attention, it is debt divided by debt plus equity. So it is debt divided by the total capital employed. If it is greater than 35%, then it pushes the KE up to 12.5%. It means that the P ratio will fall down to 8. Okay. And if it can also rise, and just look at the wordings. And so this is one more implication, that if your debt equity ratio is greater than 35%, then it rises the interest rate on the additional amount borrowed, which is nothing but 14%. Okay. Find out the probable price of the share and what is the additional funds raised by the way of loan, and also at the same time what should be your issue of equity share. So these are the two plans which we have, and based on that we have to do the calculation. Okay. Return earning is given to you as 1.2 crores. So this is one of the questions which I want you all to understand. In this particular question, what we need to do is that we have to first of all calculate what is your existing capital structure. So how do you calculate your existing capital structure? So here we have some equity shares with us. So what are the number of equity shares which we have? 8 lakhs. So don't misinterpret this as equity share capital. Here the wordings is number of equity shares. So we have the number of equity shares which is 8 lakhs. Face value is rupees 10. So 8 lakh into 10, can I say 80 lakh rupees? That will be treated as your equity share capital. Come on, yes or no? Yes, sir. Also at the same time, are we having any reserves and surplus? Yes, sir. What's the reserves and surplus which is given to you? So we have the reserves and surplus which is available as 1.2 crores. Okay. And then, my dear students, we have equity share capital, we have reserves and surplus, and then we also have some debentures with us. So this is 12 lakh and this is at the rate of 12%. So we have 1 crore worth of debentures also. So all these things which we have, and then we total it. So we will be getting whatever is the existing capital structure. Now existing capital structure is offering an EBIT of 52 lakhs. So is this data sufficient for you to calculate what should be your ROC? Come on, yes or no? Yes, sir. So this ROC can be calculated by taking whatever is your EBIT, and we're going to divide that by whatever is the existing capital employed. We'll be getting the ROC. So once we get the ROC, my dear students, we know that this return will be applicable when the company is going to do the expansion also. So from your existing capital employed, what you need to do, you have to add what is going to be the additional capital. That will give you the total amount, and the total amount multiplied by ROC is going to give you your new EBIT. Okay. And then once we get the new EBIT, from that we have to subtract interest, etc. And then accordingly we are going to do the calculations. Okay. So these type of questions are very important, where we have to structure the existing capital first. Okay. Now here, how do we calculate the debt equity ratio? So we have the debt. Now debt, do we have old and new both? Come on, yes or no? Yes, sir. In one of the plans we have old and new both. So in first plan we have old debt, we have new debt. We divide that by the capital employed, we multiply that by 100, and this will actually give you what is going to be your debt equity ratio. If it is greater than 35%, good. If it is less than 35%, my dear students, if it is greater than 35%, it means that we have to take your P ratio of 8, and your cost of additional borrowing is going to be 14%. And if it is less than 35%, then in that particular case, your P ratio will continue to be 10, and your market price is going to be 25. Okay. And your cost of, there is no cost of new funds in the second part of the question. Okay. So based on this, you are going to do the calculations. Fine. Now, my dear students, so structuring of your capital based on your debt equity ratio, etc. This type of questions can definitely be asked. Okay. So sometimes slab rate interest rate will be given to you. So what is slab rate interest rate? Suppose up to 5 lakh rupees, the rate of interest is 10%. Over and above 5 lakh to 10 lakh, the rate of interest will be different. So, you know, many of you know that how do we calculate the slab rate? It's very equivalent to what we do it in your, you know, what we do it basically in your income tax. So the same concept applies here. There will be slabs which will be given to you, and based on those slabs, we have to calculate what is going to be your interest part. Okay. So up to this much amount, what is going to be the interest? Up to this much amount, what is going to be the interest? And those slabs will be taken into consideration. Perfect. So this is something which you have to understand when it comes to capital structure theories, capital structure chapter. But here there is one more important aspect which you have to understand, which states that how much, you know, of the debt should be taken into consideration. How much of the debt should be taken into consideration? You know, when we have to you know, consider what is going to be your you know, next better plan which should be selected. Okay. So now this is something which requires your attention. Okay. Which is your question number 5. Now see what is given to you in this question number 5. Compute how much would the EBIT need to increase before the next best alternatives is supposed to be selected. Okay. Now listen to this very thoroughly. Okay. Now see, let's say for example in this question number 5, your EBIT continues to be what? Suppose it is 15 lakh rupees. So based on this 15 lakh rupees, what you have done is you have calculated what is going to be your amount of your EPS. So suppose your EBIT is 15 lakhs. From this you subtract interest, you will be getting EBT. Then you subtract tax, you will be getting NPAT. You subtract your preference dividend, you will be getting the net profits for equity shareholders. So primarily you are going to do this, divide that by number of equity shares, so you will be getting the EPS. Now you will realize that this particular question tells you that we should prefer only equity plan. Okay, when you'll be solving it, you'll understand that we are going to select only equity plan. So only equity plan is actually that plan in which the risk element is relatively lower. So when the risk element is relatively lower, when do we prefer that kind of a plan? When your EBIT is going to be less than the indifference point. So here in this particular question, we are required to calculate your indifference point. So how will you calculate your indifference point? So you're going to calculate your indifference point by taking into consideration your EPS of plan 1 should be equal to your EPS of plan 3, because your next best alternative will be your debt pala part. So once we have debt and once we have equity, we will calculate the indifference point, and the indifference point turns out to be higher than 15 lakh rupees. So now when you want to select debt in the capital structure, so in that particular case, when there is debt in the capital structure, can I put it like this, that when there is debt in the capital structure, it means what? That we will now have a higher financial break-even point, and we will select the plan in which the FBP is going to be higher. Now see, this particular question I'm talking about, question number 5. Now see, in this question number 5, see, Yo-Yo presently has 36 lakh debt outstanding. The coupon rate is 10%. It wishes to finance 40 lakhs. Okay, and it's considering additional debt at the rate of 12%. Preference shares is this. Issue of equity shares is 16. Okay. And the company presently has 8 lakh shares outstanding, and it's 40% tax bracket. Now suppose they are earning 15 lakhs and we have required to calculate the EPS at this 15 lakhs only. So based on this, just check what is going to be the solution. So your EPS will be based on that 15 lakh rupees, your EPS will be 0.495, 0.305 and 0.651. Now in this particular case, here as you all can see, it is only equity shares. Now tell me, in these 3 plans, which plan will have a lower financial risk? So your FBP is going to be lower. Why? Because we are raising the funds by the way of equity. Here your FBP can be higher. Now in this particular case, why are we still selecting the FBP plan which is lower? Why? Because here your EPS is maximum. And in this particular case, as I just now told you, if your EBIT is less than the indifference point, FBP is lower, EPS is going to be higher. So as you can just check, your EPS is highest here and FVP in this particular case is the lowest. So that's why your 15 lakh is actually below the indifference point. The next best alternative is 0.495. So when will we select this next best alternative? We are only going to select this next best alternative when your earnings is going to be more than the indifference point. So that's why there is a need to find out the indifference point between plan 1 and plan 3. So once we find out the indifference point, we come to know that this is the level of EBIT at which your EPS is going to be the same. And once we get the EBIT, suppose that EBIT is more than 15 lakhs, suppose it's 20 lakhs, 23 lakhs or 40 lakhs, whatever, then that much amount we have to earn. Only after that plan 1 will be taken into consideration, or before that plan 1 will not be taken into consideration. Okay. Before that, we will keep on selecting the plan in which the FBP is going to be minimum. So that is why your 23,76,000 is coming as indifference point. So here, if we increase your EBIT by 876, that is the scenario in which your EPS of plan 1 should be equal to your EPS of plan 2. Okay. So this is something which we need to calculate regarding your relationship between EBIT, FBP and indifference point. But then you also know that when there is theory of dominance, now when there is a theory of dominance, this is only and only applicable under a situation where you have same rate of preference dividend and same rate of interest. Now, if I tell you that the company issues 8% preference and 8% debentures, then can I put it like this? Your debentures is a cheaper mode of finance, so that should be preferred over your preference shares. Okay. So interest into 1 minus tax, that should be taken into consideration. So my dear students, always remember that when there is debt and preference shares both in the capital structure, when there is debt and preference shares both in the capital structure and both are having the same rate 8%, then debt will always dominate your preference shares, because when we are talking about debt has interest has tax savings, which is not the case in case of preference shares. So that is why, can I say debt is a cheap mode of finance? Come on, yes or no? Yes, sir. So that is why there can't be any indifference point between your debt and your preference shares when the rate is same, when the amount is same. Okay, so that is something which you have to understand when they have asked you level of dominance or which plan dominates the other. So the plan in which there is debt in the capital structure, that will always dominate the plan in which there is only preference shares in the capital structure. Why? Because of the tax savings. Okay, so that is something which is regard to your capital structures. So I think now I have taught you enough of what is your capital structure, selection of financial plan, IDP, FBP. Now I'm teaching you what is your capital structure theories. Okay, now what do we mean by your capital structure theories? Okay, so just pay attention. So I'll be quickly revising all the capital structure theories, but once again, for those who want to understand the detailed calculations, okay, then there is a revision series which is already uploaded in the same playlist, in the same channel, where you have 3 parts of revisions, in which there is revisions pertaining to your first part, in which there is ratios, leverages, etc. Then there is capital structure, cost of capital. In every particular part we have the revisions available. So if you want, you can visit that revision video, look at the capital structure theory problem, okay, which is solved in depth there. Okay, it's revised, and based on that you will come to know what is going to be your capital structure theories. Okay, so each and every question of study module is being solved there. Okay, every question of study module is being solved there. So that is why, if you, whether it's illustration or whether it's practical problem, so if you want to understand a concept in depth, so that can be done, when you are referring to your revision series. Okay, based on that you can do that. Okay, Parth, I want you to come and pay attention at a very correct path which is pertaining to your capital structure theories. Okay, so let us now deal with your capital structure theories. What is your capital structure theories? Let us now understand that. Okay, so let us start with this capital structure theories. Okay, now this is something which is very, very, very important. I am expecting one question from capital structure theories which can come even in your examination. So let us first understand what is this capital structure theories. See, basically every theory has some objective. So capital structure theories, will it have some objective? Yes. And what's the objective? The objective is to check that if the change in capital structure will have an impact in your WACC. Will it have an impact in your WACC? So when the change in capital structure will have an impact in your WACC or not, that is something which we are going to discuss in your capital structure theories. Okay, now first of all, what happens is, change in capital structure will have an impact on your WACC or not. Okay, for example, if you have debt and equity in the capital structure and the ratio which is given to you, that is 0.2 and 0.8. Suppose this is 10%, this is 15%, so this is 2%, this is 12%, the total is what? 14%. So this is your Q. But for example, if I change, Ishika, if I change the proportion from 0.2, suppose if this is 0.4, if this is 0.6, then can I say that will your KO also change? Come on, yes or no, sir? Then the answer is absolutely yes. The KO is going to change. So that is why there are some theories which supports this view that if you change the capital structure, your KO is going to change. There are some theories which will tell you that even if you change the capital structure, your KO is going to remain constant. Okay, so that is something which you are going to deal in your capital structure theories. Now there are some 3 assumptions whenever you're going to study your capital structure theories. What are the 3 assumptions? The 3 assumptions are: first, there should be no income tax. Second, there should be no preference share capital. And third, there should be no retention. So these are the 3 basic assumptions which we have to understand. No income tax, no preferences, and no retention. And based on this, we are going to prepare the income statement, which will look something like this, where there will be EBIT. From EBIT, there is minus subtract. So that will be your EBT, and this EBT itself will be treated as your dividends. Okay, now you have EBIT, you subtract interest, and then we'll be getting your dividends. So now based on this, how do we do the necessary calculations? So if you want to calculate what should be your market value of equity, how do you calculate your market value of equity? So here we are going to take whatever is your dividends, we can capitalize that by K. Or else, let us put it like this. If you want to calculate your KE, how do you calculate your KE? This KE can be calculated by taking dividends upon market value of equity into 100. Is this data sufficient for you to calculate your KE? Come on, yes or no? Yes, sir. Your KE can be calculated by taking dividends upon market value of equity into 100. That's how your KE can be calculated. Okay. Now, my dear students, if I tell you that, okay, how do we calculate your market value of the firm? So market value of the firm or market value of the company is nothing but whatever is your market value of debt, to that you add your market value of equity. Eventually you will be getting what is the market value of the firm or market value of the company. Okay, so market value of debt plus market value of equity. So if you are wondering, sir, what is market value of debt? So always remember that whatever is your book value debt, that itself will be treated as your market value debt. Okay, so your book value debt and your market value debt both are going to be the same. And then market value of equity, as I told you, you can capitalize your dividends with your KE, so you'll be getting the market value of equity. Okay. Then, my dear students, how do you calculate your KO? So this KO will be calculated by taking whatever is your EBIT and we divide that by market value of the company and multiply that by 100. So this will be treated as your KO. Okay, EBIT upon market value of the company into 100. So whatever is your EBIT, you divide that with what? Market value of the company into 100. That is eventually going to give you your KO. Okay. Now, my dear students, based on this, if I tell you that what are the different types of theories? So primarily there are 4 main types of theories. The first one, which we always do, that is net income approach, the most easiest one. The second one is called as your traditional approach. The third one, which we call it as, is called as your net operating income approach. And then we have MM approach, in which there is without tax and then there is with tax. Okay. So these are the 5 main capital structure theories. So first, when I talk about NI approach, so what does your NI approach tells you? Your NI approach tells you that if you change the capital structure, will your WACC change? Then the answer is absolutely yes. If you change the capital structure, your WACC is definitely going to change. Okay. So if suppose you have debt equity in the capital structure, if you change the proportion, then definitely your QO is also going to change. But here the important aspect is what? The important aspect is that the K is going to remain constant. So K is constant under your NI approach. But when I talk about your traditional approach, then is the K going to remain constant? Then the answer is absolutely no. Is the K going to enhance? Come on, yes or no? Then the answer is yes. And this K will increase when you see that there is more risk in the business. So can I say that higher the risk, higher is going to be your expectations of equity shareholders? Come on, yes or no? Then the answer is yes. And higher will be the risk, higher will be the KE. Okay. So when you keep on introducing more and more debt in the capital structure, will your KE also increase? Come on, yes or no? Yes. But initially this KE will increase marginally. So this KE will increase initially marginally. Okay. And then subsequently this KE will increase drastically. Okay. So first you are going to get the benefit of the cheaper debt, but then you know that is the optimum capital structure. But once you again take more and more debt in the capital structure, then will your KE rise in a way that the KO is also going to be having an impact on yes or no? Then the answer is yes, sir. Okay. So that is pertaining to your KE part. And after this, my dear students, whenever we are dealing with your, KO, so initially under traditional approach, your KO will fall and then the KO will rise. So what is going to happen to the market value of the company? Initially it will rise and the market value will fall. Okay. Because as you all are aware about this relationship, that lower the KO, higher is going to be the market value. So when the KO is falling, the market value of the company will increase. And when the KO will rise, the market value of the company is going to fall. Okay. So this is something which we discuss in your market value of the company. Okay. Now, my dear students, apart from this, we have one more approach which is called as net operating income approach. Now, in this net operating income approach, what's the most important thing you have to understand? That are we going to change the capital structure, which can lead to the change in KO? Then the answer is no. So apparently what happens in this particular approach is your KO going to remain constant? Come on, yes or no? Then the answer is absolutely yes. So your KO is going to remain constant. Okay, so the KO is not going to change, your KO is going to remain constant. And because of that, the value of the company will also remain constant. So now you must be wondering, sir, why the KO will remain constant? So your under NOI approach, your KE will increase, but it will increase in such a way that benefit of cheaper debt gets compensated by the rise in the KE. So what do we mean by this? Suppose there is debt and equity in the capital structure. Suppose your debt is 0.2, your equity is 0.8. Suppose this is 10%, this is 15%. So this will now be what, 2%, and this will be what, 12%. Total is 14%. Okay. Now let's say, for example, if I take more debt in the capital structure, so is the KO going to continue to remain 14? Yes, sir. So then this will become what? This is 0.4 into 10. So this becomes 4%. Now the balancing figure is what? This is 14 and this is 0. This is 14. So this has to be 10%. If this is 10 and this is 0.6, then can I say 10 divided by 0.6 will give you 16.67%. So has your KE increased? Come on, yes or no? Yes, sir. And the KE is increased in such a way that benefit of cheaper debt gets compensated by the rise in KE, and your KO is going to remain constant, which also means that the market value of the company is also going to remain constant. Okay. So this was something pertaining to your which approach? This was pertaining to your NOI approach. Then what comes under MM approach? So under MM approach, we have without tax and with tax. Now under without tax, it also supports the view that the market value of any particular company, irrespective of the capital structure, the market value of any particular company, irrespective of the capital structure, will always have the same value. So suppose there is levered company, there is unlevered company. What do you mean by levered company? When there is debt in the capital structure. What do you mean by unlevered company? When there is no debt in the capital structure. But under MM approach, under without tax, whether it is levered company or whether it is unlevered company, can I put it like this, that the market value of the company will remain the same, and this remains the same due to the process of arbitrage. And under MM with tax, you have to understand that in this particular case, the market value of levered company will always be greater than what? Market value of unlevered company. So in this particular case, well, the levered company will definitely have a higher market value. Come on, yes or no? Then the answer is yes, as compared to the unlevered company. Okay. So these are the different types of approaches. These are the different types of capital structure theories which you all have to understand. Okay. Now, my dear students, apart from this, now, very quickly, let us refer to some of the questions pertaining to this capital structure theory so that you understand this in in-depth way. Where we have under capital structure theories, let's say, for example, we'll be discussing MM approach, etc. Everything. I'll be teaching you how to do MM approach as well, for levered to unlevered company, unlevered to levered company, etc. Everything we'll be discussing it. So one question I'll be revising it. Now see, this will actually help you to understand, okay, that what is going to be your approach towards your studies when you'll be referring to more and more questions. Once all your concepts have been revised and you understand everything, then there is nothing to worry. Okay, you will be able to solve all the questions properly. Okay, so now let us first start with your NOI approach. NI approach, we will first, let's say, for example, we are doing your illustration. Okay, let's say 2. Okay, now see, in this particular case, what is given to you, that the EBIT which is available, that is nothing but 1 lakh rupees, and the firm makes use of both debt and equity capital, and the firm has debentures of 5 lakh and the firm's equity capitalization. So what is the total value of the firm? So it's a very easy question. How do you do it? From EBIT, we subtract your interest. What we get? EBT. That EBT itself is to be treated as your dividends, right? So you have the amount of EBIT, which is what? 1 lakh. And then you have the rate which is given to you. So there is 5 lakh rupees of debentures and the rate is 10%. So this is going to be 50,000. So your EBT or dividend is going to be 50,000. Okay. And now we are required to calculate the value of the firm. So how will you calculate the value of the firm? So in this particular case, to calculate the value of the firm, we'll be taking market value of debt, and to that we'll be adding market value of equity. So what is market value of debt? Can I say 5 lakhs, which is the book value? That itself is the market value. But when it comes to market value of equity, we'll be taking whatever is your dividends and we'll be capitalizing that by the KE, which is 15%. So this will eventually help you to calculate what is the value of the company. Okay. And once we get the value of the company, then they have asked you what is the overall cost of capital. So how do you calculate your overall cost of capital? We can take EBIT and divide that by market value of the company into 100. We'll be getting whatever is your market value of the company. Okay. So this was pertaining to your more of a NI approach, that even if you take more debt in the capital structure, what is going to happen? Because debt is a cheaper mode of finance, we are taking more and more debt in the capital structure, your overall cost of capital will fall, and then your market value of the company is going to rise. Okay, because under traditional approach, as you all are aware about the fact that your this is not going to have any impact. Your overall cost of capital is always and always going to remain what? It is going to fall. Your K is going to remain constant under your traditional approach. Okay, but now when it comes to, let's say for example, this question number 3, in which you have different types of KDs and Ks and percentage of value of debt. Okay, now we are required to determine the optimum capital structure. Now what is your optimum capital structure? It is that capital structure at which your KO has to be lowest. Okay, so KO has to be lowest and the market value of the company has to be maximum. Okay, now just check. We have options in which there is KD 11, 11, 11.6, 12, 13, 15, 18, and then we also have your KE available, and also at the same time we have percentage value. So we have the weights also given to you. Okay, now in this particular case, how do you calculate the best possible capital structure? Okay, so instead of this formula which is given to you, you can directly do it like this, that for your option 1, what is your weights of debt and what's your weights of equity? So as you all can just check, your percentage of debt, okay, is nothing but what? 0. So your percentage of debt is 0. So obviously entire fund is by the way of equity. And now what is your KD and KE? Let us write down that. So your KD is nothing but what? 11%. And what's your KE? That is nothing but 13%. So how will you calculate your KO? So whatever is your weights of debt, you multiply that by cost of debt. And whatever is your weights of equity, you multiply that by cost of equity. Ultimately, you'll be getting what is your overall cost of capital. Okay. So in this particular case, what is going to happen is that your KE itself is your KO. Why? Because there is no debt in the capital structure. So then your KO will continue to be what? It's going to be continue to be 13%. Okay. In your second part of the question, now what is happening? See, are we taking some debt in the capital structure? Yes, sir. So we are taking 0.1 debt. So in this particular case, your weights of equity is 0.9. Okay. And what's your cost of debt which is given to you? That is 11%. And what's your KE which is given to you? That is nothing but 13%. So in this particular case, what will I do? I'll take 0.1 into 11 and then I will take 0.9 into 13. And will this give me what is going to be my KO, which is 12.8%? Come on, yes or no? Then the answer is yes. So that's going to be 12.8%. So we'll calculate the KO on each and everything. And then we will select the plan in which your KO has to be minimum. So we will select which plan, beta? We are going to select your plan number 2 because here the KO is going to be minimum. Okay. So that is something which we're going to learn in this particular approach. And as I told you, under an NOI approach, your KE is always going to increase in such a way that benefit of cheaper debt gets compensated by the rise in KE, and your overall cost of capital, your KO, is always going to remain constant. Okay. So that was pertaining to your NOI approach. Now let us talk about approach. Now approach is without tax as well as with tax. So first is, let's solve without tax. Now what happens under approach is, first of all, you have to assume certain things, and that is under approach, when we are transferring from your levered company to unlevered company, then in this particular case, we have to maintain the same level of risk. Now, how do you maintain the same level of risk? So you maintain the same level of risk by taking into consideration, we maintain the same level of risk by taking into consideration your debt equity ratio of the levered company. So whenever we are going to make investments, so suppose for example, I was in a levered company, which was an overvalued company. I sold my stake from there and took the money and invested in unlevered company. Now, unlevered company definitely does not have any debt in the capital structure. So now we cannot tell unlevered company to take the loans. So in that particular case, who is going to take the loan? Then it's always the investor who will take the loan. In which proportion? In the same proportion of the levered company. And then it's going to invest the money in the unlevered company, earn some profits out of it. And that will be arbitrage profits. So has a very simple funda, which says that if suppose there is an overvalued company and there is an undervalued company, we should start selling overvalued company and start buying undervalued company. So there will be a point of equilibrium where value of both the companies are going to be the same. And in this particular case, when value of both the companies are going to be the same, your KO is also going to be constant. Okay, so your KO is also going to be constant, because what does your KO deals with? Your KO is nothing but EBIT upon market value of the company into 100. So based on that, is your KO going to remain constant? Yes or no, sir? Then the answer is yes, sir. Okay, so this is also one of the way on the basis of which you are going to do the calculation. Okay, so remember something like this, that when there is levered company and we are transferring our stake from levered to unlevered, who is supposed to take debt? the debt will be taken by the investor in the same proportion of the levered company at the same rate of interest to maintain the same level of risk, and that will generate arbitrage profits. And those arbitrage profits, because in pursuance of earning those arbitrage profits, people will start selling overvalued companies, they will start buying undervalued companies, and there will be point of equilibrium in which the value of both the companies are going to be the same. Okay, so understand a situation like this, that let's say for example, when we are dealing with okay, so first thing what you need to do is we have to find out what is going to be the market value of both the companies. So I will help you to understand one question on when we are transferring from levered to unlevered. So this is the question. As you all can just check, N and M Limited, they have the same EBIT of 20,000. So there is N, there is M. Both the companies have the same EBIT of what? 20,000. Okay, now from EBIT, what do you subtract? Interest. What do you get? EBT. This EBT you treated as what? Dividends. Now what is your interest? Just check. We have debt amounting to rupees 1 lakh and the rate of interest is 7%. Then can I say that your M, which is a levered company, N is your unlevered company? So in this particular case, you all can see that M is a levered company and this is 1 lakh at the rate of 7%. So that is why 1 lakh into 7%. So that will be nothing but 7,000. So that is why 13,000 here, and there is no interest here because it's an unlevered company. So this itself is 20,000. Now you all need to check, do you have any KE? Yes, the cost of equity of N is 10%. So N has a KE of 10% and M has a KE of 11.5%. Okay, now will this help you to calculate what is going to be the market value of equity? Come on, yes or no? Yes sir. So this will now be 2 lakh rupees. Okay, and this will be 13,000, which we divide that by 11.5%. So this will now be 1,13,043. Now in this particular case, what we need to do is we have to add the market value of debt. So what is the market value of debt which we need to add? So your market value of debt here, you can just check, is given to you. That is nothing but how much? Your debt amount is 1 lakh. So in this particular case, your debt amount is 1 lakh. So here, if you just check the total, this is 2 lakh rupees and this is 2,13,043, which means that, can I say unlevered company, levered company has a higher market value than the unlevered company. Now, when the levered company will have a higher market value, we have to assume that an investor, Mr. X, has 10% stake in the levered company. Now, when it has 10% stake in the levered company, what is he going to do? He's going to sell the stake. So he is going to get market value of equity, which is 1,13,043. So 1,13,043 into 10%. Can I say that 11,304, that is going to be the amount which is going to receive. And now when this 11,304 amount is going to receive, with that, he also has to take some loan. And this loan will be in the same proportion of the levered company. So levered company, how did it take the loan? So 1,13,043, that was your equity and your debt was 1 lakh. So now for example, 11,304, if this is your equity, what should be your amount of debt? So 10,000 is your amount of debt. So the total amount which comes with the investor is 21,304. And what the investor is going to do with this 21,304, he is going to invest in the unlevered company. So when he's going to invest in the unlevered company, if I just calculate what is the percentage stake in your unlevered company, then your percentage stake will be 21,304. Divide that by 2 lakhs into 100. So this will now be 21,304. If I divide that by 2 lakhs and multiply that by 100, so then you'll be getting the percentage stake, that is 10.652%. Now this 10.652% is nothing but the percentage stake of the investor in the which type of company? Then it is the percentage stake actually in your unlevered company. Okay, now we have to just check what is going to be the arbitrage profits and how do you calculate that. So to calculate the arbitrage profits, first we have to take whatever is the dividend which is received from your unlevered company. First we need to check that. Okay, from your unlevered company. So now because you are an investor in your unlevered company actually gives you a dividend of what? 20,000. Okay, but now you have not invested full 100% stake. So then you can just multiply this by 10.652% stake, or you can use proportionate method also. You will come to know 20,000 into 10.652%. So 2130.4. This is nothing but how much dividend you are going to earn from the unlevered company. Now, have we taken some loan? Yes. So we have to subtract the interest cost. So what is going to be the interest cost? So suppose your interest cost is nothing but, you have taken the loan of 10,000 and the rate of interest of 7% will be applicable to you. The same rate of interest which the levered company is there. So that's going to be 700. So if I subtract 700 from this, you will be getting 1430. Now this is the net gain which you are getting from unlevered company. But from this, we also have to subtract what is going to be the dividend lost from your levered company. Because in your levered company, you were having 10% stake. So when the company was distributing 13,000 dividend, so you were subject to get 1300 dividend. So now you are actually earning 130 rupees extra. So this will be called as your arbitrage gain. So what is your arbitrage gain? So your arbitrage gain, my dear students, is nothing but the arbitrage profits which you are going to earn because you are shifting your investments from unlevered to levered. From levered to unlevered. And here, when the people will start selling levered company shares, they will start buying unlevered company shares. So what will happen is ultimately both of them will reach at a point of equilibrium. Okay. So that is something which we understand here. And then, my dear students, when it go reverse. So in this reverse case, we have to understand that when we are shifting from your unlevered company to your levered company, so instead of taking loan, we have to give the loan. Okay, so you can just refer to my revision series question in which I've solved this entirely. So you'll come to know that what is the process. Okay, so it's the same steps, but here the only thing is we are going to now give the loan to the levered company and earn the interest income and take that into consideration. Okay, so that is something which is going to be taken into consideration. Okay, so how did we get this 130 rupees? So 130 is nothing but what? From 1430, that was your net earnings from your unlevered company. From that, if you subtract the dividend loss from the levered company, which is 1300. So how did we get this 1300 rupees? This 1300 rupees was earlier you were having 10% stake, right, in your levered company. So dividends dividends which were distributed by the levered company, that was 13,000. So from that 13,000, you are going to get your 10%. So 13,000 into 10% is nothing but what? 1300 rupees. So that's how this 1300 rupees has come. And this will give you your arbitrage gain of 130 rupees. Okay. So that is one of the way to calculate it. So that's how we transfer from levered to unlevered and unlevered to levered company. Okay. Then, my dear students, let us do the last thing of this chapter, which is nothing but with tax. So whenever we are dealing with with tax, you have to understand that for why not 11.5? I didn't get it. Why 11.5%? Because we were having 10% stake, na? KE is 11.5%, beta. You have to first understand that what is your percentage stake? What is your percentage stake in your levered company? So you had 10% stake. KE is your expectations, but you are going to get the dividend on how much amount you have invested. So that's why 10% should be taken into consideration, which is your stake. Okay. Or else you can also do it like this. See, what is the market value of equity which you have? Suppose the market value of equity which you have, that is nothing but 10% stake, right? So see, these guys are actually giving you 1,13,043 ke samne 13,000. But you have 10% stake. So 11,304 ke samne how much? So that will give you your 1,300 rupees only. Okay. So whatever you have in, or else you can also put it like this: 11,304.3. You have 10% stake in your unlevered company, in your levered company. Okay. So this is the stake which you have. Now, what is the dividend which is being distributed? So basically your expectation is 11.5%. So you take 11,304.3 and multiply that by 11.5%. So you'll be getting here exactly your 1,300 rupees only. So you can do it in different types of ways. I've showed you 2-3 ways, but I would prefer that whatever is your dividend distributed, that is 13,000, you have to take 10% out of it. So 10% out of it is nothing but 1,300 rupees. Okay. Now let us deal with your with tax. Okay. I hope you have understood. Please write down in the chat box whether you have understood this or not. Hello. Yes, sir. No, sir. Come on fast. Now let us deal with your with tax. Okay. Now what happens in your with tax? Now, whenever I'm dealing with with tax, your specifically tells you that if the tax rate is given to you, then your market value of levered company will always be greater than the market value of unlevered company. Okay. Your market value of levered company will be what? Always greater than market value of unlevered company. Now, this market value of levered company, why is it greater than the market value of unlevered company? That is because of the tax impact and the tax savings on the same. So here what we have to do is market value of levered company will be treated as market value of unlevered company plus whatever is your debt, you multiply that by your tax rate. Okay, so based on this, you are going to calculate what is the market value of the levered company. Okay, so let's say, for example, what is market value of unlevered company? So that is nothing but whatever is your dividend, you capitalize that by KE. Because for an unlevered company, is there any debt in the capital structure? Then the answer is no. There is only equity in the capital structure. So whatever is your market value of equity, that itself is the market value of the unlevered company. Okay. And then there is debt into tax rate. So whatever is the amount of the debentures, you multiply that by tax rate. So you'll be getting the tax savings on the same. And when we add it together, we get what is the market value of the levered company. Okay. Now, for this particular question, I just want you all to refer to your question number, 10. Now, in this particular question, see, Blue is an all equity finance company. It's purchasing repurchase of 275 lakh equity share and to replace it with 15% debentures of the same amount. So what is happening? Are we actually converting from equity to debt equity? Come on, yes or no? Yes. Okay. So now Blue Limited, once it becomes levered company, will definitely have a higher market value as compared to, unlevered company. Now what is given to you further? Current market value of the company is what? 1750 lakhs with its cost of capital, which is nothing but 20%. Okay. So now we are going to have a cost of capital, which is nothing but 20%. And the EBIT is expected to remain constant. And there is 30% tax rate. You are required to do the following calculation. So what should be your approach first? So your approach will be, first the company was what? Unlevered. And then the company wants to be converted into levered. So how do you start with this? From EBIT, if you subtract interest, what do you get? EBT. And from EBT, if you subtract tax, what do you get? You get your net profits after tax, which is also called as your dividends. Okay. Now just check that you have market value of the company, which is 1750, and your K is 20%. So can I put it like this? 1750 lakhs, that's the market value of your company or equity because it's unlevered. And if you multiply that by your 20%, ultimately what we get is your dividends, right? Because what is KE? KE is dividend upon market value of equity into 100, right? So if I have the KE, if I have the market value of equity, if I multiply this two, will I be getting the dividends? Come on, yes or no? Yes, sir. So my dividends will now be 1750. You multiply that by your 20%. So you'll be getting 350. So 350 is your dividends. Now you have to go reverse. How will you go reverse? So in this particular case, do you have the tax rate which is given to you? Yes, that's 30%. So 130, this is 70. Can I get the EBT? Yes, sir. I can get the EBT, which is 350 into 100. Divide that by 70. So that is nothing but 500. And then there is no interest. So your EBIT will be 500. So this will also be 500. Now we are taking loans of 275 lakhs at the rate of 15%. So you take 275 and multiply that by 15%. So this is 41.25. Eventually this is 233.75. And now what's the tax rate which is given to you? That is 30%. So you multiply that by 30%. This is 70.125. And eventually you'll be getting the final answer, which is 163.625. Okay. So this is nothing but the format of the income statement which we are going to follow. Now, I think there is some mistake which I have done here. 1 second. This is 500. Your interest is 41. Okay, so I think there is some mistake here. 500 minus 41.25 actually will give you 458.75. And this 458.75, you subtract the tax at the rate of 30%. So you'll be left with 321.125. Okay, so this is the final answer. Now, my dear students, we have got unlevered and levered company. Now we just have to calculate what should be the market value of the levered company. So can I say market value of your levered company will be nothing but what? Market value of unlevered company plus debt into tax rate. So your unlevered company market value is going to be what? So we'll be taking into consideration whatever is your dividends. Okay, unlevered company market value is anyway which is given to you, that is 1750. And then you take debt and multiply that by the tax rate. So do you have the amount of the debt? Yes. We have the amount of the debt, and your amount of the debt which is given to you, that is 275 lakhs. So you take 275 lakhs and multiply that by your tax rate, which is 30%. That will give you market value of levered company. Now in this, don't forget that this market value of levered company needs to be divided into debt and equity. So we have to take into consideration what should be your equity part. So debt part, so you already know. What's the debt part? Your debt part is nothing but the 275 lakh rupees loan which you have taken. Balance part is your equity. And once we get whatever is your equity, then what will we eventually do is we'll be using your KE/KO calculation for the same, and same concept will be applicable. Net profits available for equity shareholders, divide that by whatever is your market value of equity and into 100. So as you can check that the market value of levered company is 1832.5. You subtract the debt part, so this is your equity. Okay, now once we have got the equity, what we have to eventually do is whatever is the net income, you divide that by market value of equity into 100, will be getting 20.62%. Cost of debt, we have to convert that post tax, so you multiply that by 1 minus tax, and that will be 10.5%. and eventually, my dear students, we will be eventually getting what is your KO, which is coming as 19.11%. But the best thing which you have to understand is that whenever there is a levered company, always remember that in that levered company you will be having lower WACC, you will be having higher market value, and your KE will be slightly more because you have taken debt in the capital structure. So these are the three things which will happen when you are converting from unlevered to levered. So when you are converting yourself from unlevered to levered, will your market value of the company will be higher? Yes, sir. Will your KO will be lower? Yes, sir. And is your KE going to be increased? Yes, because of more risk in the capital structure. Okay, so with this, my dear students, we have also completed your capital structure and your capital structure theories. So everything with regards to your cost of capital, capital structure theories, YTM, etc., everything is completed. Okay, now we will take a break of 30 minutes. And after 30 minutes, my dear students, we will be continuing then with the next chapter. Okay, and the first chapter which I want to take after this will be your dividend decisions. Okay, and then we'll be doing your investment decisions. Okay, and then we'll continue further with other small chapters like leverages, etc. We'll be doing it. Okay, so now let us take a break of 30 minutes, and I'll see you somewhere around 10:15, 10:10 and 10:15, and then we'll continue this further. Okay, so yes, if you have a doubt, then you can please write down in the chat box so that we can continue further. Okay, so that's it for the time being. Okay, and whatever doubts you have now, Parth, you can just WhatsApp it, and based on the WhatsApp, then I'll just check it and then I'll revert back to you. Okay, but right now let's take a break of 30 minutes, and after that we'll continue this further. Okay. Okay, so my dear students, are you all back? Let us continue this further. अभी मुझे दो डाउट्स किसी ने चैट बॉक्स पे पूछे. एक, व्हाट इज द फ्लो ऑफ द सम if they give a return on capital employed. So Parth, whenever there is a return on capital employed, आपको किस चीज के ऊपर फोकस करना है? दैट फर्स्ट स्टेप इज दैट वी हैव टू कैलकुलेट व्हाट इज योर टोटल अमाउंट इन्वेस्टेड. फिर जो भी आपका टोटल अमाउंट इन्वेस्टेड है, you have to multiply that by whatever is your first you have to understand that what is the additional funds which is required. So existing capital employed plus additional funds, this together will give you your total capital employed, and then you'll multiply that by the return, and that will give you your EBIT, and then we have to prepare the income statement as usual. Okay, so that is something which we are going to do it. Okay, now one student has asked, sir, is the ROE is cost of equity same? No, ROE and KE is not the same until and is specifically given to you. So for that we will understand it with the help of the next session which we are going to do in the next dividend decisions. What we're going to do, I'll explain to you what is your KE and how are we going to take into consideration your ROE. Okay. Perfect. Chalo. So now let us start, my dear students, with your next chapter, and the next chapter which I want you all to do is going to be your dividend decision. Okay, so let's do your dividend decisions now. So basically, when we are going to deal with your dividend decisions, the first thing which you'll have to understand is that whenever we are going to have your dividend decisions, now my dear students, what is the basic meaning of the word dividend decision? See, tell me one thing, that is it mandatory? Is it mandatory for the company to distribute equity dividend? Then the answer is absolutely no. So your equity dividend completely depends, upon the CFO of the company, whether they want to distribute your equity dividend or not. Okay, so it depends on what is the growth prospects, whether the company is into growth phase, whether the company is into saturation phase, and based on that they will decide that whether they want to distribute your equity dividend or not. Okay, now see, my dear students, when we are going to deal with your dividend decisions, okay, see, there are some few things which you'll have to understand in your dividend decisions. Okay, see, if suppose the company has generated some profits, now if the company wants to expand and grow, then in that particular case, can I say that the retention is going to be relatively higher? And when the retention will be higher, can I say that the growth can also be faster? Come on, yes or no? Yes, sir. But if suppose the company during the growth phase is going to distribute your dividends, then in that particular case, the equity shareholders of the company will not like it. Matlab, just imagine a situation where you know that you are an investor of a company which is growing at a very faster pace, but whatever is the profits which the company is generating, if suppose they distribute that by the way of dividends, then will the equity shareholders like it or they will not like it? Then the answer is they will not like it. They will rather sell the shares of the company. Why will they sell the shares of the company? Because they will think that, hey, listen, when the company has to expand and grow, this particular company is rather distributing the dividend. So in that particular case, what is going to happen is that they will start buying the shares or they will start selling the shares. Then in that particular case, they will start selling the shares. So management of the company, they have to make very wise decisions, because ultimately every decision which you make as a CFO of a company should only have one particular objective, and the objective is to maximize what? Is to maximize the wealth of equity shareholder. Okay, so the objective is very simple, and the objective is to maximize the wealth of what? Is to maximize the wealth of equity shareholders. It's a very simple concept that whenever you will be involved in your dividend decisions, you have to make sure that any decision which you make should maximize the wealth of equity shareholder, and that particular wealth can be maximized when your market price per share increases. Okay, so just understand a situation where, let's say for example, there is a particular company which is having an earning per share of rupees 10. Okay, and let's say for example, if this particular earnings is invested in some particular project, then that project is going to fetch you a return of, let's say for example, 15%. And expectation of equity shareholders is, let's say for example, 10%. Okay, so equity shareholders are expecting just 10% from the company. Now, how this KE can be calculated? It can be calculated with the help of CAPM model. You know, it can be calculated by any particular way, but this KE is coming as 10%. So equity shareholders are expecting 10%. This particular company is generating a returns which is at the rate of 15%. Earning per share is 10 rupees. Okay. Now, in this particular case, what should be your price of an equity share? If the company distributes a dividend of rupees 8. Now tell me one thing, that the company has an earning per share of 10 rupees. R is greater than K. It means that if you retain the profits, you can reinvest it in some project which can fetch you a return of 15%. So it can fetch you a return of 15%. Now just imagine that that particular project can fetch you a return of 15%, but people are just expecting 10% from you. So R is apparently greater than K. Now, as a CFO, what should you do? Should you distribute the dividends or should you retain it? Then the answer is you should retain it, because you are generating higher returns as compared to the expectation of equity shareholders. So your retention is actually higher. So you should definitely retain it. Come on, yes or no? Then the answer is absolutely yes. So in this particular case, if suppose the company still distributes a dividend of rupees 8 per share, then what do you think is going to be impact on the price of the company? So for that particular case, we are having something which is called as your Walters model. Now what happens in a Walters model? We take into consideration P0 is equal to DPS plus, what do we take? EPS minus DPS into R upon K, and we are going to capitalize that by K. So it's DPS plus EPS minus DPS into R upon K, which we are going to capitalize by K. Now please tell me, what is your dividend per share? Your dividend per share is 8 rupees. Your earning per share, how much is it? It is 10 rupees minus dividend per share, which is 8 rupees. What's your R? 15%. And we divide that by 10, and then the entire thing we capitalize it by 10%. So what is going to be the implication? Then can I say 8 plus 10 minus 8, that is 2 into 1.5. Divide that by 10%. So in this particular case, 8 plus 2 into 1.5, that is 3, and which we capitalize it by 10%. So ultimately, what's the market price, which is coming 110. But still, my dear students, let me tell you that this is not the best market price of the company. Now, when the R is greater than K, your dividend distribution should actually be 0. You should not even distribute even a single rupee by the way of dividend. So now when you don't distribute the dividend, can I say your earning per share is 10, you don't distribute the dividend, this will be 15 divided by 10, and you capitalize that by 10%. So this will now be 10 into 1.5, and if I capitalize that by 10%, so this will now become what? 15, which I capitalize it by 10%. What's the market price? It's 150. So can you all understand this, that the market price of the share is higher when your R is actually greater than K and the payout ratio is 0. This is called as your optimum capital structure. So under Walters model, what do we have to do in dividend decisions? We compare your R with your K. Now, if R is greater than K, your optimum payout ratio is 0. When R is less than K, your optimum payout ratio is 100%. And when R is equal to K, then your payout can be any particular payout ratio. It can be any payout ratio. Why? Because the market price is going to remain the same. So does dividend decision have an impact on the market price of the company? Come on, yes or no? Then the answer is absolutely yes. Dividend decisions will have an impact on the market price of the company. But it all depends what is your returns which is generated and what is your expectation of equity shareholder, and based on that we do the necessary calculation. Okay, so Walters model, my dear students, is also known as all or nothing model. So why do we call that as all or nothing model? Because in your Walters model, they specifically tell you that if you want, you distribute 100% of dividend, or you don't distribute the dividend, but then the market price is going to be maximum. So it's called as optimum market price, optimum payout ratio. So in dividend decisions, what are we going to study is what is going to be your impact on the market price based on different dividend decisions model. So we have something which is called as your Walter, then we have something which is called as your Gordon, then we have Walter, then we have Gordon, then we have MM approach, then we have your Linters approach, then gram and dot approach. So these are the different types of approaches on the basis of which we are going to do the dividend decision. I just give you a brief introduction about what is your Walters model. Okay, so as we have understood Walters model, what is going to be the formula to calculate the price? So it is DPS plus, what do we do? EPS minus DPS into what? R upon K, which we capitalize it by K, right? Gordon. Now what does Gordon tells you? So as per Gordon also, market price is going to have an impact based on the dividend decisions of the company. Now, as you all are aware, how do you calculate your KE using Gordon's model? So dividend discount model or dividend yield growth approach, how do you calculate your KE? You calculate your KE by taking D1 upon P0 into 100 plus G. That's how we calculate your KE, right? So this is how you calculate your KE. Now, if suppose I want to find out the market price, what do? I take KE minus G is equal to D1 upon P0 into 100. So if I take here P0, this should be D1 upon KE minus G into 100. So that's how we calculate the market price. Come on, yes or no? Yes, sir. So now, my dear students, your KE should actually be greater than G. Because if your KE is less than G, then don't you think that your market price will become negative? Come on, yes or no? Yes, sir. So your KE should always be greater than G. And based on this, we actually calculate what should be your P0. Now, my dear students, Gordon also tells you that if suppose your dividend proportion is going to change, then can I say that the P0 is also going to change? Come on, yes or no? Of course, yes, absolutely yes, it's going to change. Okay. So this was something which was pertaining to your Gordon's model, where your P0 was nothing but D1 upon KE minus G. Now, what does MM tells you? So MM tells you that the value of the company will remain the same irrespective of the fact whether you distribute the dividend or you don't distribute the dividend. So the value of the company will always remain the same whether you distribute or whether you don't distribute. So in that particular case, what is the formula which you'll use? Dividend plus earning minus dividends into for MM approach. Now the formula which you are going to use, and that will be nothing but N plus change of N into P1 minus I plus E upon 1 plus K. This is the formula which you are going to use to calculate the value of the company. And is this value of the company going to remain constant irrespective of the fact whether you distribute the dividend or not? Yes or no? Yes, sir. And then we have Linter's approach, gram and dot approach. So what is first of all Linter's approach? This will be used to calculate your D1 dividend. Okay, what should be your distribution of dividend? And gram and dot will be used to calculate what should be the price based on your dividend and earnings and the multiplier effect. Okay, so that is pertaining to gram and dot. So both of them are ancillary models, but still we are going to refer to the formulas for the same. But first, my focus is Walter, Gordon and MM. Okay, now let us first very quickly do something pertaining to your Walters model. Okay. Perfect. Now see, in your Walters model, if you just read this particular question, okay, see what is given to you, that net profits is given to you, that is nothing but how much? 30 lakhs. Outstanding 12% preference shares, that is nothing but 100 lakhs. Number of equity shares is 3 lakhs. Return on investment, that is your R, and this is your K. Compute the approximate dividend payout ratio so as to keep the share price at rupees 42 by using Walters model. So now we have to keep the share price as rupees 42. So basically what we are going to do is, can I put it like this, that as per Walter, what's your P0? It's dividend plus earning minus dividend into R upon K, which we capitalize by K. So in this particular case, what is going to be your market price per share? The market price is nothing but 42 rupees. So let this be 42. Okay. Now let the dividend be X. Now, what is your earnings? As you all know that your net profits, now what will you interpret this net profits as? So this net profits is nothing but your NPAT. So from your NPAT, what do? We subtract the preference dividend. What do we get? Net profit for equity shareholders, which we divide by number of equity shares. So we'll be getting your EPS. So your NPAT is available. How much is that? 30 lakhs. What's your preference dividend? As you all can see, 100 lakhs into 12%. So that is 12 lakhs. So this is 18. And what's your number of equity shares? Your number of equity shares is 3 lakhs. So that's where EPS is 6. Now in this particular case, you have your EPS of 6 minus X. What's your R? Your R is nothing but 20 and your K is 16. And we are going to capitalize this by 16%. So in this particular case, we'll take 42 into 16%. So that is 6.72. And this will be x plus 6 minus x into, now we have to take 20 divided by 16, and that will be nothing but 1.25. So ultimately when we open up this bracket, we'll be getting 6.72 is equal to x plus 6 into 1.25, that will give you 7.5 minus 1.25x. So now this is going to be 7.5 minus 6.25, sorry, 6.72. So that will give you 0.78. Okay, and this will give you eventually 0.25x. So now your 3.12 is nothing but your dividend per share. And once we have got your dividend per share, which is 3.12, what are we going to do with the same? We are going to now check what is the market price per share. So what's the market price per the share? So market price per share, what's your earning per share? Your earning per share, which we have just now calculated, that is nothing but your 6 rupees. So what are we going to do is your dividend payout ratio will be 3.12, which I'm going to divide that by 6 into 100. So this will now give me 3.12, divide that by 6 into 100. So that's nothing but 52%. So that's your dividend payout ratio. So just check, we are going to get 52%. Okay. Then regarding your Gordon's model, as we all are aware about the fact that at different types of your payout ratios, will your market price be having different impact? Come on, yes or no? Yes, sir. Now see, we have net profits, we have outstanding, we have number of equity, RO, return on investment, and then we have K. Now in this particular case, what's the earning per share? So if you just calculate net profits minus dividend, we'll be getting your earnings for equity shareholders, which we divide by number of equity shares. You have a EPS of 6 rupees. Okay. Now, the first thing which you have to learn is how do we calculate the growth rate? Because can I put it like this, that growth rate is nothing but retention into ROE, isn't it? Retention into ROE. Will that give you the growth rate? Come on, yes or no? Yes, sir. So we will take retention and we multiply that by ROE. Now, will your retention percentage change? Of course, yes. So when your dividend payout ratio changes, your retention percentage will also change. And that should make you understand that your growth rate is also going to change. So now what is going to be your retention? So if this is 25%, so this will now become, retention will become 0.75. And what's your return on investment? 20. So what's the growth rate in the first case? You take 20 and multiply that by 0.75. So your growth rate is 15%. So now in the first case, what is the growth rate which you are going to get? You are going to get 15% as the growth rate. Okay. In the second case, at different payout ratios, we'll be getting different growth rates. So this is 10%, this is 16%. So different payout ratios will have different growth rates. Now, how should you treat your earnings as? Okay. Now see, you must be worrying, okay, sir, what is this? P0 is equal to E1 into 1 minus B. Now this is nothing but your P0, which is nothing but earning per share into payout ratio. 1 minus B means 1 minus retention. So 1 minus retention is payout ratio only. So don't be worried about this formula. Earning per share into payout ratio. Just do it the way we have done it in the class. Earning per share into payout ratio, which we are going to capitalize by that by KE minus B into R. So what is B into R? KE is nothing but the growth rate. B into R is your growth rate. Because what is growth rate, beta? Growth rate is nothing but retention into ROE. So retention is B and this is R. So this is nothing but B into R, which is growth rate. So don't be worried about this formula. We can simply take EPS into payout ratio and divide that by KE minus, whatever is the retention into ROE. So what's your EPS? As you all can see, your EPS is coming as 6. And what's your payout ratio? In the first case, your payout ratio is 25%. So 6 into 25%. Now 6 into 25% will give you what? 1.5. So then you can take 1.5 and divide that by KE minus G. Now here there can be two views which can be possible. Whether we should treat this as your D1 or should we treat it as your D0. Because if you're treating this as a D0, then we have to add the growth rate to it. But if you're treating this as D1, then in this particular case, we will be considering that as your D1 itself. So no growth rate needs to be added. So whenever we are doing dividend decisions, in dividend decisions, in all ICI solutions, whether it is Gordon's approach or Walter's approach, this earning per share, etc., until unless specifically mentioned, is treated as E1 only. Okay, you can have a definitely alternative view, but we will take into consideration your E1, D1, etc. and do that accordingly. Okay. So that is going to give you the 3 market prices of the shares. Okay. Then my dear students, we have something which is called as your two-stage growth model, and this is something which is very important, which can be helpful to you for your examination. Now see, how do we calculate the value of a stock? Okay. Now in dividend decisions, how do you calculate value of stock? Now let's say, for example, I'm giving you some situations. Okay. The first situation is, let's say for example, the dividends are constant in nature. The dividends are constant in nature. Now you must be wondering, what is the meaning of dividends are constant in nature? It means that, let's say for example, the dividend per share is ₹5 and that is constant till perpetuity. And expectation of equity shareholders is, let's say for example, 10%. Now if I ask you what is the market price of the share, then how do you calculate the market price of the share? Then we have to take DPS and we have to capitalize that by KE. So once I take DPS and capitalize that by KE, what I will get is 50 rupees. So this 50 rupees will be treated as your market price per share. So when dividends are constant, you know, when dividends are going to be constant towards perpetuity, your market price per share will become dividends upon KE. Right? Now, the second part is when dividends are growing at a constant rate. Now, when it is specifically mentioned that when the dividends are going to grow at a constant rate, in this particular case, if you have to calculate your P0, what do you need? You need DPS. Suppose that DPS is 5. Suppose your KE is, example, 10% and your growth rate is 5%. And you are required to calculate market price per share. Now this P0 will be calculated by taking D1. So what's your D1? Can I say D1 will be 5 rupees plus growth rate of 5%, divide that by KE minus G, because here I've assumed this as your D0. So then in this particular case, what we have to do, 5 plus 5%, and if I divide that by 5%, ultimately what I'm going to get, rupees 105. So here the market price of the equity share is 105. So it's a very simple concept. When dividends are constant, then we can simply take dividend and capitalize it. But when the dividends are growing at a constant rate, can I use Gordon's model and calculate what can be the price? Come on, yes or no? Yes, sir. But when there are multiple stages of growth, so how do we find out the value of an equity share? And this value of an equity share is actually called as your intrinsic value. What is it called as? It is called as your intrinsic value of a share. Now in this particular case, how do you calculate your intrinsic value? Now to calculate your intrinsic value, let's say for example, year 1, 2, 3, let's say, you know, the dividends are growing at the rate of 10%. Suppose year 4 to 5, the dividends are growing at the rate of 8%. And from 6th year onwards, the dividends are going to grow at 5%. Suppose this is the data which I give you. And if I tell you that the last dividend paid was ₹10, okay? And if I ask you that if the K is given to you as, let's say for example, 10%, then what should be the P0? What should be the market price per share? Now definitely you cannot use the first model. Why? Because here dividends are not, in the first model here it was mentioned dividends are constant, but here the dividends are not constant. Are the dividends growing? Yes or no? Yes. But they are not growing at a constant rate. If they must have grown at a constant rate, then I would have used my Gordon's model. But here, can I say there is multiple stages of growth rate? Come on, yes or no? Yes, sir. Now, when there is multiple stages of growth rate, what am I going to do? I'll be taking here, can I say here it will be 1, 2, 3, and then here it will be year 4 and 5. Can I say at least for 5 years, my dividend per share and my market price per share, I can find it out. So what is going to be my dividend per share at the end of year 1? So guys, if this is the last dividend paid was 10 rupees. So if I take this 10 and if I add the growth rate of 10%, can I say 11 rupees? That will be the dividend at the end of year 1. Then from 11 rupees, I will add once again 10%. So then that will be what? 12.1. And from 12.1, if I add 10%, that will be 13.31. But now in 4th year, what is happening is this 13.31, I have to add it at a growth rate of 8%. So now what is going to happen? If I take 13.31 and add 8% to this, so I'll be getting 14.37. And if I take 14.37 and add 8% to it, so I'll be eventually getting finally 15.52. Are these going to be my dividends per share? Come on, yes or no? Yes, sir. Now at the end of the 5th year, I want to calculate price at the end of the 5th year. Now, why do we calculate price at the end of the 5th year? Because we can only apply Gordon's model when the growth rate is constant towards perpetuity, and the growth rate is constant from 5th year onwards. So can we calculate P5? Yes, sir. How will we calculate P5? By taking D6 upon what? KE minus G. So what is your D6? So this D6 is nothing but 15.52. We add the growth rate to it. And what's the growth rate? 5. Because now it's going to grow at the rate of 5, and divide that by KE minus G. My KE was 10%. So 10% minus 5%. So what is going to be the price at the end of the 5th year? So this will be 15.52 plus 5%, which I'll divide that by 5%. So eventually I'll be getting what? Rupees 325.92. So can I say the price at the end of the 5th year will be 325.92? All these are in future value terms. I should discount it at whatever is my KE, which is 10%. Can I say I'll be getting the present value? Come on, yes or no? Yes, sir. I'll be getting the present value. So this is how we find out what should be the present value of an equity share. Okay. But this is only and only applicable when there is multiple stages of growth rate. So this is how we calculate the intrinsic value. And then my dear students, we have something which is called as approach. So under approach, what do we do is we find out the value of the company by taking n plus change of n into P1 minus I plus E, divide that by 1 plus KE. So apparently what happens in approach is, says that whether you declare the dividend or whether you don't declare the dividend, the value of the company is always going to remain the same. Okay. Now what happens is, let's say for example, for one of the questions in which there is we will solve it from your study module. So see what is given to you. Let's say for example AB engineering. Okay, now it belongs to a risk class with the capitalization rate which is nothing but 10%. So we know that AB engineering has a K which is nothing but 10%. Okay, now it currently has 10,000 shares outstanding. So what is your existing number of shares? It is 10,000. And also at the same time, you know what is given to you, that it is selling at rupees 100 each. Okay, so it has 10,000 shares which is selling at what? Rupees 100 each. So do we have the market price of the share? Yes, and that's nothing but 100 rupees. The firm is contemplating the declaration of dividend of rupees 5 per share at the end of the current financial year. So they are thinking that they want to distribute a dividend which is nothing but what? Rupees 5 per share. And also at the same time, it expects to have a net income of rupees 1 lakh. So we have our earnings of rupees 1 lakh at the end of year 1, and as a proposal for making a new investment of rupees 2 lakhs. So we have our new investment of rupees 2 lakhs. Okay. Now calculate the value of the firm when the dividends are not paid and when the dividends are paid. So when the dividends are not paid, what should be the value? And whether the dividends are paid, then what should be the value? So here, what is the conclusion? That the value of the company is going to remain the same. Okay. Now, my dear students, we have to calculate the value of the company. Whether the dividends are not paid or if they are paid, what should be the value of the company? Okay. Simple concept, my dear students, when you have to calculate what should be the value of the company, okay, the first thing what is required is that we should know what is your change in N, and also at the same time we should know what is the P1. So how do you calculate your P1 then? So see, market price today is nothing but future value benefits we discounted and we bring it to the present value terms. So we have D1 and P1 both as my future value of cash inflows which is going to be generated, and then I divide that by 1 plus K. This actually gives me my present value. So what is your D1 which is given to you? So D1 is nothing but 5. What is your P1? Let that be X. And then my dear students, what's your P0? Your P0 is 100. And this is nothing but 1 plus what's your K? Your K is nothing but 10%. So in this particular case, this is 100 is equal to 5 plus X upon 1.1. So in this particular case, this is 110 is equal to 5 plus X. Can I say I have got my P1 when the dividends are not paid? Sorry, yeah, I have calculated when dividends are paid. I'll do here when dividends are not paid. Okay. So then in this particular case, I can find out when the dividends are paid, the price is coming, that is nothing but 105. And when the dividends are not paid, can I say my D0 should be 0? My D1 should be 0. Let the P1 be X, 1 plus 0.1. So in this particular case, my P1 will be 110. Okay. So now I am having the two prices. Come on, yes or no? Yes, sir. Parth, we have the two prices. And what are the two prices which we have? When the dividends are paid, the price is 105. And when the dividend is not paid, the price of an equity share is 110. Okay. Now, similarly, how will you calculate your change in N? So what is the fresh issue which you are going to make? So this fresh issue, for that we have to take into consideration your investments minus whatever is going to be your retained earnings. Okay. And that is something, investments minus whatever is going to be your retained earnings, that will give you fresh issue. And that is something which we divide that by P1. So what is going to be your investments? So your investments, what is your investment? Your investment is 2 lakhs. Okay. Ishika, what is your investment? 2 lakhs. What is your retained earnings? So now, my dear students, when the dividends are paid, can I say my retained earnings is going to be lower? How? Because my earnings is 1 lakh, and from this 1 lakh, I am paying a dividend of 10,000 shares of rupees 5 each. So 10,000 into 5. So earnings minus dividends will give me retained earnings. So then in this particular case, from my 1 lakh rupees of earnings, suppose if I've given a dividend of 10,000 into 5, that is your 50,000. Then can I say 50,000 rupees? That is nothing but what is going to be your retention? Come on, yes or no? Yes, sir. So now we will take retention of 50,000 rupees. And we divide that by P1. So what's your P1? Your P1 which you have just now got is 105. So now 2 lakh minus 50,000, divide that by 105. So this will eventually give you 1428.57 shares. So my dear students, what is your existing number of equity shares? So your existing number of equity shares was nothing but how much? Your existing number of equity shares was 10,000 and the fresh issue. So 10,000 was your existing and the fresh issue is 1428.57. So eventually, if I add both these things, I'll be getting what? 11,428.57 shares. So is this going to be your total number of equity shares? Come on, yes or no? Yes, sir. Okay. So when the dividends are paid, then obviously the total amount is going to be lower, right? So don't we reduce ND also? Yeah, so that's what we have done now. From 10,000 shares, if I multiplied by 5, so that is nothing but your dividends paid. So from your earnings, if I subtract my dividends, then this is nothing but my retention, which is 50,000, right? So 2 lakh minus your retained earnings, right? So my retained earning is 50,000. So it means that now there is a fresh issue. And because of that, there is 11,428 shares. Now I need to multiply this by the P1. So what's your P1? So your P1 is nothing but 105. So this will now give you into 105, which will give you approximately, how much is this coming? This will be coming as your 12 lakh rupees. And then from your 12 lakh rupees, we'll be subtracting minus I plus E. So what was your minus I? How much investments you had to make? You had to make an investment. In the question they have told you that is 2 lakhs. So that is minus I 2 lakhs and earnings was nothing but 1 lakh. So in this particular case, 12 lakh minus 2 lakh, 10 lakh and 10 lakh plus 1. So the total value of the company is coming as 11 lakh rupees. Just check what's the total value of the company which is coming here. It is coming as 10 lakh rupees. So apparently what we have got as when the dividends are paid. So balance funds required is what? Yes, 1,50,000. And based on this, we have calculated. So eventually we have got this as value of the company. Just check this out. This minus 2 lakh and your earning is 1 lakh. Right, so we'll be getting the same answer only. Okay, so here also when the dividends are not paid, we will use the same process. So is the market price per share going to be what? Okay, and then we have to capitalize that also by, so this is 11 lakh and we divide that by 1.1, which is your K. Ultimately we'll be getting the value of the company, that is 10 lakh rupees. Same process applies here. So when the dividends are not paid, what we do is we calculate what's your P1. Your P1 is coming as 110. And once you get your P1, now when dividends are not paid, can I put it like this, that your entire earnings will be your retention. So what's your entire earnings? It is 1 lakh. So then this 1 lakh, we will be dividing that by what's the price. So the price is going to be nothing but how much? When the dividends are not paid, your price is going to be 110. So this will now give you eventually what is the change in shares. So that will now be 1 lakh divided by 110. So 110 ke saath if we divide it, we will be getting what are the number of equity shares? 909 shares, 909.09 shares. So ultimately, if I take 10,000 and if I add 909.09 shares, ultimately this will be 10,909.09 shares, which I need to then multiply it by whatever is the market price. So what's the market price? 110. And eventually I'll be getting this as, how much amount is this coming? This will be coming as 10,909.09, multiply that by 110. This amount comes as 12 lakhs minus I. So what's your investment? Your investment is 2 lakh plus E, which is 1 lakh. So eventually this will be 11 lakh. You divide by 1.1, which is the 1 plus K. Ultimately this will be 10 lakh rupees. So come what may, your market value of the company will continue to be 10 lakh rupees. Okay. So this was your MM approach. So I've solved one question on MM approach. Similar type of questions, you can solve it. Okay. Then my dear students, the next thing which I want you all to understand will be your, your Gordon's, your Graham and Dodd model. So here the price of the equity share can be calculated by taking M into dividend plus E by 3. So that is how we calculate the price of an equity share. How do we calculate it? M into D plus E by 3. Okay, so whatever is your multiplier, that will be an arbitrary number which will be given to you, and D plus E by 3. So based on that, we'll be getting the price of an equity share. Okay, so that was pertaining to Graham and Dodd model. Okay, now my dear students, so all these illustrations you can solve it accordingly. Okay. So we have understood dividend discount models and everything. Now I want you all to come to this particular question. Okay, in which we have the concept of, okay, buyback of shares and stock split. Okay, so this is something which is new, which is there in the study module. So they have asked a question on this earlier also, but let us do this once again. So Mr. H is currently holding 1 lakh shares of HM, and currently the share of HM is traded in Bombay Stock Exchange at rupees 50 per share. Okay, now Mr. A have a policy to reinvest the amount of any dividend received into the shares back again of HM Limited. Now Mr. A have a policy of to reinvest the amount of any dividend received into the share back to this particular shares of HM Limited. If HM has declared a dividend of rupees 10 per share, please determine the number of shares Mr. A would hold after he reinvests the dividend in the shares of HM Limited. Now see, what is the basic meaning of this? So this is Mr. A, who's currently holding 1 lakh shares. Okay, and the price is 50 rupees. Now what is happening is that the company has declared a dividend of rupees 10 per share. So this is your cum dividend price, which is 50 rupees. And from that, if I subtract the dividend per share, I will be getting the ex dividend price of 40 rupees. Now in this particular case, how much amount do you have? So if you guys can just check that you are going to get a dividend of how much amount? 1 lakh shares of rupees 10 each. So you're going to get 10 lakh rupees. Now this 10 lakh rupees, you will reinvest it at 50 rupees or 40 rupees. So after the dividend is being declared, definitely it becomes ex dividend price. So you will have it at 40 rupees. So what are we going to do? From this 10 lakh, if I divide that by 40, ultimately 25,000 shares will be available. Now once you have this 25,000 shares, what we need to do is, ultimately, what are the total number of the shares which he has? So earlier he had 1 lakh shares, and then he has 20,000 shares, 25,000 shares. So the total number of shares will be nothing but 1,25,000 shares. So here the concept of cum dividend and ex dividend is applicable. That once the dividend is being declared, the price of an equity share becomes ex dividend. And when it becomes ex dividend price of an equity share, what we need to do is, we will simply take into consideration whatever is going to be, your final, amount which you have received by the way of dividend. You will divide that by whatever is your ex dividend price per share. You will come to know what are the total number of equity shares he has purchased, and old plus new both put together will give you your total number of holdings. So that is pertaining to buyback and repurchase of reinvestment of your earnings into your dividends. Okay, reinvestment of your dividends by way of purchasing the equity shares of the company. So that is something which we have discussed in your question number 8. Okay, now let's talk about your question number 9. Now question number 9 is about buyback. Okay, Yeah, ex dividend does not include any interest, or it does not include any kind of your dividend per share. So that is after the, so just imagine something like this now. The market price was 50 rupees. The company decides to declare a dividend of 10 rupees. So after the dividend has been declared, the market price will become 40 rupees. So this is called as ex dividend price. So when you have received the dividend of 10 lakh rupees, you will now again purchase the shares of the company. So you will purchase it at 50 rupees or 40 rupees. Of course at 40 rupees, because after dividend is declared, the market price is 40 rupees. So this 10 lakh, if you divide by 40 rupees, ultimately 25,000 shares is there. All shares is 1 lakh. So total it will become 1,25,000 shares. Okay. Now let's do the next thing. So in the next question, what do we have? This is regarding your buyback. Okay. So what is there given to you? Following information is pertaining to your DG, where you have number of shares outstanding, we have earning per share, we have your PE ratio, we have your book value per share, which is 400. If the company decides to repurchase 25,000 shares at the prevailing market price, what is the resulting book value per share after repurchase? Now in this particular case, what should be your prevailing market price? Okay, what should be your prevailing market price? What is the resulting book value per share after the repurchasing? So what are we going to do? So in this particular case, my dear students, we have number of shares outstanding 1 lakh, we have EPS, we have PE ratio, we have book value per share. So now, if the company is repurchasing, it means they are buying back the shares at the market price. So if I have EPS and if I have PE ratio, can I get the market price per share? Come on, yes or no? Yes, sir. So what is going to be the solution of this? So I have the market price per share of 500. Now, I am actually buying 1 lakh shares at, what was the book value of the company before the buyback? That was 4 crores. Now, what is the amount paid for the repurchase? So we are buying back 25,000 shares of rupees 500 each. So how much is the amount which is going out from the pocket? It is 1.25 crores. So what will be the book value after the buyback? It is 2.75 crores. And what are the number of shares outstanding? That is 75,000 shares. So if we divide this to, ultimately there is 367 rupees per share. So this is how we calculate what is going to be the book value per share after the buyback. Okay. Because see, whenever there is going to be buyback, can I put it like this, that your number of equity shares will apparently reduce, and along with that, we are buying back that at your market price. So then it is going to have an impact on the reserve. So ultimately your equity shareholders fund is going to fall. So we had 4 crores of the existing equity shareholders funds. Now what is going to happen is we are going to buy back 25,000 shares of rupees 500 each. So ultimately 1.25 crores, this is the amount paid on repurchase. So ultimately the book value of the company is what? It is 2.75 crores. And that is something which we're going to divide that by number of equity shares, which is 1 lakh minus 25,000. So 75,000 shares are left. So book value per share is 367. Okay. So this is something regarding your dividend decision. So these all questions, I want you all to do it properly. Okay. Now, can you please explain question number 9 again? Okay, ठीक है, चलो. I'll explain to you this once again. See, let us put it in this way. देखो. What you have to first find out, what is the book value per share after the repurchasing? See, understand something like this. If there is a company and the company is involved into buyback of equity shares, what happens is that the number of equity shares after the buyback will fall. Barabar? Because the company is buyback, it is entering into a transaction where whatever is the shares which is there in the market, they are going to buy back. Okay. So the number of equity shares is going to fall. Okay. Now understand something like this. We are going to do the buyback at the market price. So usually in real life now, buyback is done at a premium. It is supposed to be done at a premium more than what is going to be your market price per share. So suppose market price per share is 500 rupees now. So buyback usually happens at more than the market price per share, okay, which is EPS into P ratio. But here they have told you at market price per share. So fair enough. We are going to do buyback of equity shares at rupees 500. Now just check and tell me that what are the number of shares outstanding? 1 lakh. Okay. And what is the book value per share? 400. So what is the equity shareholder funds? Can I say it is nothing but 4 crores? Okay. Now we are doing buyback of 25,000 shares at rupees 500. So in this particular case, what is happening is that your equity shareholder funds will reduce by how much amount? So your equity shareholders funds will reduce by total 25,000 into what? 25,000 into what? What's the market price? The market price is nothing but 500. So it is going to be reduced by 1 crore 25 lakhs. So in this particular case, what's your revised equity shareholders funds? So revised equity shareholders funds is nothing but 3.75 crores. 2.75 crores. And what are the number of equity shares which are there after the buyback? So in this particular case, from 1 lakh shares, 25,000 shares has gone. So now you are left with what? 75,000 shares. So when you take 2.75 crores and you divide that by 75,000, ultimately what is going to happen is you'll be getting your finally, your post buyback book value per share. Okay. So which turns out to be how much? This turns out to be 366.67. So this was your question. Got it? Okay. Perfect. Chalo, great. Now, after dividend decisions, we have covered all the concepts here. Okay. Now let us do something which is pertaining to your investment decisions. Okay. So let's do your investment decisions now. Okay. So again, a lengthy chapter, but we are going to at least revise each and every method once. Okay. So that it becomes easier for you when it comes to your, solution and how do we approach the question, all those things. So I'll make you revise everything about investment decisions here. Okay. And some of the important transactions of some questions as well. Okay. Are you guys ready? Shall we start? Just write down in the chat box. Okay. Shall we start now with your investment decisions? Next chapter. Okay. Great. Chalo. Now, my dear students, let us do investment decisions, which is related to your capital budgeting decision. It deals with how do you invest and where do you invest your capital. So basically, my dear students, when I'm talking about investment decision, okay, it deals with your decisions which are made, investment decisions in your fixed assets and in your working capital. Okay. So basically there are two types of investments which you have to make when you have to start with the project: investment in fixed assets and investment in working capital. Okay. Now, my dear students, investment decisions, if you want to evaluate different types of fixed assets, if you want to evaluate different types of projects, then in that particular case, we are having some methods to make evaluation of such kind of projects. So how many types of methods are there? So there is something which is called as your net present value. Then there is something which is called as your payback period. Okay, but first let me write down NPV and then profitability index. Then we will write down IRR method. Then we'll write down payback period method. Then we will write down discounted payback period method. Then after this we have ARR method. And then towards the last we have something which is called as MIRR method. Okay. Now these are the 7 main important methods on the basis of which we can evaluate a particular project. Okay. Now basically what is your NPV method? So what is NPV? What is net present value? We take present value of cash inflows and we subtract present value of cash outflows. Okay. No, you cannot skip this chapter. Just pay attention. Okay. We have present value of cash inflows from which we have to subtract your present value of cash outflows. So that will actually give you your NPV. Okay. Now, always remember like this, that whenever we have to calculate your present value of cash outflows, there are two types of cash outflows which are going to be there. So cash outflows pertaining to your initial investment and cash outflows pertaining to your investment in working capital. Okay. So initial investment and working capital. Now these both investments, when do we have to make? Usually we make this investments today itself, and hence we have to multiply it by 1. So that is why this will be called as your PV of CI, PV of CO under both the situations. And my dear students, what is your PV of CI? So present value of cash inflows. So cash inflows are apparently of 3 types. Number 1, cash inflow from projects. Number 2, cash inflow from salvage. And number 3 is your recovery of working capital. So my dear students, this cash inflow from projects, it means that, you know, if you're setting up a plant and machinery, that plant and machinery will generate some sales from which you will subtract variable cost, contribution, etc. So you will get some cash inflows, and this cash inflows, if it is constant, then we use present value annuity factor, and if these cash inflows are not constant, then we use something which is called as table and PV factors, on the basis of which we calculate the present value. Salvage and recovery of working capital, we are always going to recover when? We are going to recover the same at the end of the project, and hence we multiply that by the PV factor at the end of the project. Okay, so we multiply that by the PV factor at the end of the project. Now, my dear students, all these things we have understood, but at the same time, what is the discounting factor? So for a company, always remember your cost of capital is your discounting factor. So 1 divided by 1 point discounting factor, will that give you your PV factors? Come on, yes or no? Yes, sir. So now, let's say for example, your discounting factor is 12%. So 1 divided by 1.12, will that give you your PV factor? Come on, yes or no? Yes, sir. Now, whenever the cash inflows per annum are constant, we take cash inflow per annum, multiply that by PVAF to ultimately get something which is called as PV of CI. So let's say for example, every year I am saving 10,000. I'll multiply that by PVF to get my PV of CI. But if suppose every year, if it is different, like 10,000, 15,000, 5,000, then what we do, we discount it at different rates. We get the PV of CI. From that, we subtract the PV of CO. But when it comes to your PV of CO, you have to remember that when it comes to your salvage and recovery of working capital, we need to multiply that with what? With the PV factor towards the end of the project. Now in NPV decisions, you have to understand that if there is any cash outflow avoided, then those cash outflow avoided will be treated as your cash inflows. So that will be treated as your savings. And any additional cost which is being incurred, then that will be treated as your cash outflows. So from the savings, what do? You subtract this kind of additional cash outflows to get the net savings. And this net savings is called as your NPBDT. And from NPBDT, what do you subtract? Depreciation. What do you get? NPBT. And then you subtract your tax. Ultimately, what you get is your NPAT. And to this NPAT, you add the depreciation. You will be getting finally your cash inflow. So this is the format of the income statement which we usually prepare. So if savings is given to you, you can prepare it from that perspective. So always remember something like this, that whenever we are doing evaluation of a project, it is important that how do we evaluate a project? We can evaluate a project based on what? On the basis of the cash inflows which is generated by taking sales, etc. Or else you can also take into consideration savings, etc. But come what may, we can calculate the cash inflow from the project and then adjust the depreciation, and then we can do the calculations accordingly. But here you have to remember that if the tax rate is not given to you, then in that particular case, your NPBDT itself will be treated as your cash inflows. Okay. Now, my dear students, while doing your investment decisions, you have to remember that your working capital can be in the form of your let's say for example, your working capital can actually be in the form of your stock, materials, etc. Okay. And if they tell you in the question that, you know, you have to invest stock, if you have to invest materials, then always remember that it is forming part of your working capital. Okay. And then we always recover this working capital towards the end of the project. So that's why we multiply that by the PV factor. Okay. Now, my dear students, you have to understand one more important aspect here, that in your NPV decisions, there are certain types of cash outflows, cash inflows which we have to avoid it. So there are certain types of cost which we have to avoid it for the purpose of decision making. So in the entire investment decisions, there are three types of cost which we ignore from the decision making perspective. Now, what are the three types of cost which we ignore? So the first type of the cost which we ignore in your investment decisions is called as your something which is called as your historical cost, because historical cost is the cost which you have already incurred at past. So we don't take into consideration your historical cost. Secondly, there is something which is called as irrelevant cost. So irrelevant cost also we ignore from the decision making perspective. And because irrelevant cost is the cost which we have to incur it anyway. Whether you go for this decision or that decision, irrelevant cost is anyway supposed to be ignored. So that's why we ignore it from the decision making perspective. And then, my dear students, we have something which is called as your allocation of overheads. So does allocation of overheads forms part of your decision making? Then the answer is no, because this is mere distribution of expenses. So allocation of overheads will not be forming part of it. Okay. Then, my dear students, when it comes to your cash outflows, as I told you that we have to make investment in the fixed assets of the company. Now, this investment in fixed assets can be made today itself, or it can be also made at the end of the year one. Whatever is your investment which you make, you multiply that by the PV factor to ultimately get what is going to be your present value, and this PV of CO should be taken into consideration. Okay. Now comes the most important part. How do we take care of your depreciation? So depreciation can be calculated on SLM or else on the base of WDV basis. Now, when I'm talking from the SLM perspective, how do you calculate SLM? So we take original cost minus scrap, divide that by life. We get the depreciation. Or else when we take WDV basis, then what happens is whatever is your block, this block we multiply that by the depreciation rate to eventually get something which is called as your finally your depreciation. Okay. So this is something which I'll explain to you when we'll be doing replacement questions. So this is what is pertaining to your NPV. But remember here that any kind of opportunity cost, do we have to adjust the same? Come on, yes or no? Then the answer is yes. So let's say, for example, you're involved in some decision making where you want to replace the old, you want to, let's say, for example, set up your own diagnostic center. Or you want to set up your own business. Now, when you want to set up your own business or your own diagnostic center, what happens is that the customers which comes to you, earlier you were, sending them to some lab and they were actually giving you, the lab people were giving you some commission. Okay. So you are earning some commission income. But when you open your own diagnostic center, what happens is that such kind of commission will not be earned in future. So in that particular case, this becomes your opportunity cost, and any kind of opportunity cost should be adjusted from your income statement. Come on, yes or no? Then the answer is absolutely yes. And any kind of savings definitely needs to be added back. But it is important that such kind of opportunity cost and savings, whether it is pre-tax or post-tax, if no information is given to you, we will treat it as your pre-tax. We'll always treat it as your what? We'll treat it as your pre-tax. And based on that, we are going to do the calculation. Okay. So we will adjust it before the tax rate. But if they specifically tell you that this is post-tax, then we will adjust it after the tax has been calculated. So after the cash inflow. So towards the end, we are going to make such kind of adjustments. Okay. Now, my dear students, this was regarding your NPV. What is your second method, which is profitability index? So profitability index is nothing but PV of CI upon your PV of CO. That will be called as your profitability index. So we take simply PV of CI, divide that by PV of CO. And what is your IRR? Now, IRR is a rate at which your PV of CI is equal to your PV of CO. So this is what IRR is. So we have to find out that discounting factor by using trial and error method, in which your PV of CI is equal to PV of CO. And then, my dear students, we have at IRR, always remember that the profitability index is always going to be 1. And then, my dear students, what do we have next is that whenever we have payback period. What is payback period? Payback period is nothing but the time period in which you are going to recover your investments. And this payback period can be calculated in two ways. Whether the cash inflows are constant and whether the cash inflows are not constant. Guys, whenever the cash inflows are constant, can I put it like this, that your payback period is nothing but cash outflow upon cash inflow per annum. So suppose, for example, 1 lakh rupees is my outflow and every year I am receiving 10,000. Then 10 years, that's nothing but my payback period. And when the cash inflows are not constant, what do? We take into consideration cumulative cash inflow method. So we'll be having year 1, 2, 3, 4, 5, whatever is the cash inflows which we have, we are going to do CCI, and then we need to check between which 2 years, you know, your cash outflow is being recovered, and that should be taken into consideration. Then, my dear students, we have something which is called as your discounted payback period. Now, this payback period had a problem. What was the problem in the payback period? Now, this payback period had a problem that we were not able to actually find out the time period in which the investments were getting recovered. So that was the problem. But then, my dear students, we have discounted payback period. Now, in payback period, we ignore time value of money. In discounted payback period, we are going to consider the time value of money. So what is going to happen in your discounted payback period? So in your discounted payback period, what you are going to do is we will be taking into consideration your cash inflows every year. Then whatever is the cash inflows every year, we'll be discounting it at some particular percentage. So we will be getting the PV. And once we get the PV, we'll be using this particular present value of cash inflows to judge whether we should make investments or not. So we will be taking cumulative cash inflows and then we'll be calculating the time period. So the difference between payback period and discounted payback period is that in the discounted payback period, we'll be taking the cash inflows and then we'll be discounting it. We'll be getting the PV, and based on that, we'll be getting the CCI. And then, my dear students, we have something which is called as ARR. So what is ARR? It's an extent in this particular method. What do we do is we take whatever is your average NPAT, and this average NPAT, we divide that with what? Your initial investment into 100, but more preferably we take average investment, which is nothing but original investment plus scrap, divide that by 2, and this ARR should also be higher the better. Okay. Now, based on this, now let us come to the questions. Okay, and very quickly we will understand all the important parts of the questions. Okay, all the different types of the questions. Okay, and that will really help you to understand this in much better way. Okay, fine. Chalo. Now all these examples are okay. We will now first start with your, okay, now just come to illustration 2. Now a project which is requiring an investment of rupees 10 lakhs, okay, and it yields a profit after tax and depreciation. So this is profits after tax and depreciation. So this is your normal NPAT which is given to you. And now suppose further at the end of the 5th year, the plant and machinery can be sold for 80,000, determine the ARR. So now how are we going to calculate what should be your ARR? So this ARR will be calculated by taking average NPAT. So what is average NPAT? We have total NPAT. We'll divide that by number of years. So we'll be getting your average NPAT, which is 92,000, and we can divide that by average or initial investment. So your investment was 10 lakh rupees. So either you can divide that by 10 lakhs or you can take whatever is 10 lakh plus what is your salvage. So your salvage value was nothing but how much? Your salvage value was 80,000. So 10 lakh plus 80,000. You divide that by 2. So that is nothing but 10 lakh 80 divided by 2, 5 lakh 40. And based on that, you will be getting into consideration what is going to be your final answer. And that will be your 17.04%. So that will be treated as your ARR. So this is one of the ways on the basis of which you can calculate your ARR. NPV method, as we just discussed, we can take the cash inflows, discount it and bring it to the present value terms. Now here in this illustration 4, are the cash inflows constant? Come on, yes or no? Yes, sir. So simply we can multiply that by PVF. We'll be getting the PV of CI, and then we'll be subtracting the PV of CO. We'll be getting the NPV. For project B, can I say compulsory we have to prepare table and then calculate it, and we'll be getting PV of CI, subtract PV of CO, we'll be getting the NPV. Then, my dear students, what is desirability factor? So desirability factor is also known as profitability index, and we simply calculate that by taking PV of CI and we divide that by PV of CO. Okay. Then, my dear students, how do you calculate your IRR? So as we have discussed that for calculation of IRR, we prepare a range in which one PV of CI will be greater than PV of CO, one PV of CI will be less than PV of CO, and then between the two, we'll be calculating using interpolation, we'll be calculating the IRR. Okay. So I don't want to teach how do we calculate IRR because you all have sufficient practice about how do we calculate IRR, because here the objective is to solve some, good questions and interpret different types of transactions here. Okay. Now see in this illustration 8, what is given to you? Capital asset is 3,60,000 and then the life of the machine is 5 years and the salvage value is nil. the machine will produce the net operating income after depreciation, which is 68,000. And then the company's tax rate is given to you. Okay. Yes, they do ask all the types of methods, so we have to do that. Okay. So basically what do we have? We have, see, the net operating income after depreciation. Now, when the net operating income after depreciation is given to you, what does it mean? It actually means that we have your NPBT, right? And from this, then we have to subtract the tax. We'll be getting NPAT. Then we add back the depreciation. We calculate the cash inflows, and then we have to calculate IRR. So we can take a range and check between which two particular case your IRR is going to be achieved. Okay. Then, my dear students, continuing this further, okay, what is this MIRR? Now, let me revise this MIRR. So, what happens in MIRR is that we are going to deal with reinvestment of a particular cash inflows at cost of capital, okay. So, what happens is, let's say, for example, a project, it generates cash inflows for the period of, let's say, 5 years. So, we have cash inflows available for 5 years. What are the cash inflows? The cash inflows are 30,000, then 40, 60, 30, 40, 60, 30. And then we have the last thing which is given to you, and that is nothing but 20. Now, what happens in MIRR is that we have to reinvest this cash inflows. So now what is the reinvestment rate? So the reinvestment rate is always the cost of capital, which is 8%. So we have to reinvest it at 8%. So please tell me, this 30,000 you have received at the end of year 1. Now, when you reinvest it, can I say the remaining number of years is 4 years? So we have to reinvest this for the period of 4 years. So we can take 1.08 raised to the power 4. Similarly, this 40,000 which you have received at the end of the second year, you can reinvest it for the remaining, how many number of years left? 3 years, because we always receive the cash inflows at the end of the first year or at the end of the second year. So whenever you are receiving the cash inflows at the end of the second year, so 40,000 rupees, what we are going to do, we will reinvest it for the period of what? For the period of remaining 3 years. So you can take 1.08 and raise to the power 3. You can take 1.08 raised to the power 2. You can take 1.08 and here you can take 1. And based on this, you can get what is going to be the terminal value. So how to get the terminal value? So this is 1.08 raised to the power 4. So square cube 4. You multiply simply that by 30,000. So you will be getting 40,815. So this is how we'll be getting the total values. And if we add all these things, we'll be getting the terminal value. And that terminal value is coming as 2,13,587. So once we get this 2,13,587, so see, this 20,000 into 1 will become 20,000 only. But this 30,000, if it is reinvested even for 1 year, then can I say the cash inflow at the end, the terminal value will now become 30,000 into what? 1.08. So that will be 32,400. And that's how we have to calculate it. Now, at MIRR, the concept is simple, that PV of CI should be equal to your PV of CO. So PV of CI, PV of CO, both should be the same. So now what is the PV of CO? Just check. Your PV of CO is 1,36,000. So now we have to find out the discounting factor at which, when this 2,13,587, which is received at the end of the project. So that's the terminal value. So we'll multiply that by the PV factor at the rate of -% at end of 5th year. We'll be getting what is the PV of CO. So then you can apply the same IRR concept. So what you can do is, let's say for example, this is 2,13,587. Let us take a discounting factor of 10% and check. Now, if you take the discounting factor of 10% and you come to know that your PV of CI is coming, let's say for example, less than the PV of CO. So suppose your PV of CI is coming as 1,30,000, whereas your PV of CO is 1,36,000. So don't you think that your PV of CI is less than the PV of CO? So in this particular case, what we need to do, that we have to reduce the discounting factor, because once you reduce the discounting factor, your PV of CI enhances. So we have to find out that particular discounting factor at which your PV of CI and PV of CO both has to be the same. So if this is 1,30,000, this is 1,36,000. So can I say this 1,30,000 is less than 1,36,000? So here what we are going to do is, we have to now further reduce the discounting factor. So we might try it at 8%. And then suppose if this is coming as 1,38,000. So this is greater than 1,36,000. So now can I create a range? Come on, yes or no? Yes, I can definitely create a range, because at 8%, approximately, suppose I'm getting 1,38,000 at 10%, I'm getting my PV of CI as 1,30,000. So don't you think 1,36,000 is between the two? Then you can use your interpolation and do the calculation accordingly. So I hope you all know how to do the interpolation. It is 8% plus something. What's the difference between 8 and 10? 2% difference. And in this 2% difference, if suppose I've discounted 8,000 rupees, then from 138, I just wanted to reach 136. So for 2,000 rupees, this should be how much? You cross multiply, you will be getting the percentage. And then we add both these things and we'll be getting what is going to be your modified IRR. So these were just approximate figures which were taken. So this is what MIRR does to you. That we have to first calculate the cash inflows, reinvest it, get the total cash inflows. And once we get the total cash inflows, that is in future value terms. And we are going to receive it towards the end. So what needs to be done is you have to multiply that by whatever is going to be your PV factor to ultimately get what is the PV of CO, and then based on that we can get the final answer. Okay, have you understood this much part, which is your MIRR? Now in this particular case, all this as an NPV and IRR calculations are nothing different in these kind of questions. Okay, but now let us do a question on capital rationing. Now what is capital rationing? Capital rationing actually means logical allocation of funds. Okay, now remember like this, that there are two possibilities which are there in your capital rationing. So in your capital rationing, we have whether the projects are divisible or whether the projects are indivisible. Okay, now if the projects are divisible, my dear students, it means that your partial investments are possible. Okay, and we give the projects priority based on their profitability index. So we are going to calculate PIs, and once we calculate PI, we are going to rank the projects based on PIs and then try to invest in the project first in which the rank is first. And when we are falling short of funds, whatever is the differential amount which is being left, that differential amount which is being left, that we will invest in a project in which there will be the next rank possible, and we will earn full NPV or we will earn partial NPV. Then the answer is partial NPV, because we have invested partially. So the NPV which will be earned, that is also going to be partial. Okay, so that is something which we are going to learn in this capital rationing. And when the projects are indivisible, what we actually do is we create different type of projects. We create projects, and based on the projects we come to know that where the NPV is maximum. Based on that we make the investments. Okay, so see, if you just check the total of the investments part, you will come to know 50 plus 40 90 plus 30 120 plus 25 155 and then 180. You will have this much amount available. But then in this particular case, you have this much amount available, but if you invest in all these projects, then you will need more than 1,20,000, but you just have 1,20,000. Then in that particular case, we have to do partial investments. And how will you do that? So in this particular case, what will you do is you will first calculate your PI, profitability index. And once you calculate your profitability index, you will come to know this is 1, 4, 3, 5, 2, etc. So you will start investing in the project in which the PI is maximum. So as you can just check here in project E, the PI is first rank. So project E, you will invest the full amount of 35,000 and you will get an NPV of 19.3. Then your project 2 is nothing but B. So once you invest in B, then in this particular case, you are going to invest how much amount? 40,000, and you are going to earn the full NPV of 18.7. Then project C, you have full money available because you have 120 and till now 120 is not exhausted. So you can invest 25 and earn the NPV of entirely 10.1. But when it comes to project D, you have only 20,000 left, and here this project D requires 30,000. So your partial investments is going to be possible. So if you just invest 20, you are not going to get the full NPV, because on 30,000 you get an NPV of 11.2. If we invest 20, then we are going to get proportionate NPV, that is 7.5. And that's how on 120 you are going to get 55.6. So this is what we do it. Okay. Then my dear students, there is something which is also called as NPV per annum. Now this concept has to be used only under a situation when the project lives are different. So here, as you can just see that here the project life is 6 years, here the project life is 3 years. So when the project lives are different, we calculate NPV on per annum basis, and we calculate the project in which your NPV per annum is going to be maximum. Okay, so we just can't directly compare the NPV. We have to calculate NPV on per annum basis, which is also called as equivalent annualized criteria. Okay, so equivalent annualized criterion. So based on that, we can calculate what is going to be your NPV per annum. And how do you calculate NPV per annum? So NPV per annum is nothing but your NPV, which you are going to divide by PVAF at some particular percentage for dash number of years. So that is how we are going to calculate your NPV on per annum basis. Okay, and then my dear students, this question is okay, no problem. NPV per annum, as I told you, you can calculate it accordingly. Okay, now this question number 17. Now in this question number 17 also, what is happening is that we are purchasing a plant worth rupees 80 lakhs. These are the cash flows. We are required to calculate payback period, then discounting factor at 10%. So simple calculations. So payback period, here the cash inflows are not constant. So what are we going to do? We are going to use your cumulative cash inflow method, and based on that, the calculation needs to be done. Okay. Then my dear students, we will do the next question, and that is your question number 18. Now this is a very nice question, because this is a question on replacement decision. Now what happens in replacement decisions? For example, you are having an old machine. Now you want to replace the old machine with a new one. Now when you want to replace the old machine with a new one, the first thing which you have to understand is that we have to learn how to calculate your incremental NPV. How do we calculate what is going to be your incremental net present value? Incremental NPV. Okay. Now what is going to be your incremental NPV? Now pay attention. Now what is going to be your incremental NPV? Just pay attention. See, basically what happens is that, for example, we are having an old machine. Okay. And this old machine was generating a cash inflow of, let's say, 1 lakh. Now I replace this old machine with a new machine which is generating a cash inflow of 1,50,000. Then can I say I am earning an extra cash inflow of 50,000? Now when I am earning an extra cash inflow of 50,000, this 50,000 rupees of cash inflow is earned every year. Okay. So then I can multiply that by PVAF to actually get what is my PV of CI. Suppose my PV of CI is coming as 2,50,000. And if the new machine is just costing 2 lakh rupees, then can I say I should replace the decisions? Come on, I should replace the machine, yes or no? Yes, sir. Why? Because my PV of CI is greater than my PV of CO. So my PV of CI, which is getting generated, that is greater than the PV of CO. So here it is 2,50,000, here it is 2 lakh. So I am earning extra 50,000. So here, my dear students, I am generating extra amount. So my NPV is incremental. So we should replace the new machine. We should replace the old machine with the new one. So that's the basic objective. But here there are plenty of things which have to be taken care of. Now see, this company is replacing a manually operated old machine with a fully automated new machine. Now the old machine has been fully depreciated for tax purpose, but it still has a book value of 2,40,000. It doesn't matter to us because it was fully depreciated for tax purpose. So now further depreciation on old machine is not possible. Though in your books of accounts you are charging depreciation, income tax department, they don't care. Okay. Then the machine has begun causing problems with breakdowns, and it cannot fetch more than 30,000 if sold in the market. It will have no realizable value after 10 years. So there is no salvage. The company has been offered 1 lakh for the old machine as a trade for the new machine. Now, if suppose you're buying a new machine, the new machine cost is 4,50,000, and you are exchanging that with the old machine, and that old machine is going to give you 1 lakh rupees. Now tell me one thing, if you sell the old machine in the market, you are going to get 30,000 rupees. But if this old machine is exchanged, you are going to get 1 lakh rupees. What do you think you should do? Of course, I will replace the old machine and I will exchange it, because here the exchange value is higher. So then my PV of CO will now become what? 3,50,000. The expected life of the machine after 10 years will have a salvage value of 35,000. So old machine does not have any salvage, and after the period of 10 years, and new machine has a salvage of 35,000. So there is an incremental salvage which is also there. Further, the company follows straight line method of depreciation, but for tax purpose we have to use WDV method, and that is at the rate of 7.5%, considering there is only one asset in the of the machine in the block of the asset. Now see, under block of assets now, there can be two possibilities. One is that there can be only one asset in the block, or there can be multiple assets in the block. Now, those who have done tax, they are aware about the fact that if there is only one asset in the block, and if you just sell that one asset, then we have to see whether the sale consideration is greater than WDV. Okay. Or else, if the sales consideration, one second, what is written? Yeah, okay. When the sale consideration is less than the WDV, okay. Now, if the sale consideration is greater than WDV, then we attract capital gain tax. And when the sale consideration is less than the WDV, then there is short-term capital loss. But we are actually not going to be taking into consideration capital gains, because it will be specifically mentioned that we have to ignore capital gain tax. So there is no capital gain tax concept. Okay. So here also it is specifically mentioned that ignore capital gain tax. Okay. In multiple assets of the, when there in the block now, then your capital gain liability will not attract. Here the block will continue to exist even when one asset is sold and the new machine is being purchased. In both the scenarios now, just remember one very simple thing, that if suppose your old machine is getting exchanged and you are purchasing the new machine. So now you are purchasing the new machine for what price? Just check. You are purchasing the new machine for what price? For 4,50,000. But you are getting the exchange value of 1 lakh. So ultimately your block value increases by how much amount? 3,50,000. So now, my dear students, the depreciation needs to be charged on this 3,50,000 rupees. So do we have to charge the depreciation? Yes, sir. But this depreciation needs to be charged on how much amount? On the amount of 3,50,000. So that's how, my dear students, we are going to charge your depreciation. Okay. So this is called as your incremental depreciation, which will be charged on WDV basis. Now, my dear students, we have old machine, we have sales, we have material cost, we have labor, variable overhead, fixed overheads, then we have depreciation. But this depreciation is of no use to us. Then there is PBT. So can I put it like this? If there is PBT which is given to you, which is 324,750 and 387,250, can I say to this PBT, if I add the amount of depreciation, what will I get is called as NPBDT. And this NPBDT, I'll be getting it. So what's your depreciation? 24,000 and 41,500. So if I add the amount of the depreciation, I'll be getting the NPBDT. And once I get the NPBDT, now it means what? If I'm using the old machine, this is the net profit before depreciation and tax. If I'm replacing that with a new one now, then this is the net profit. So how much is the extra I'm earning? So that's the difference between the two. And that incremental NPBDT will then be subject to your depreciation. So as we have just discussed, this is 348,750, this is 420. So the difference is 80,000. So this 80,000 is your incremental. It's the extra profits before depreciation and tax which you're earning, and on that you have to charge the depreciation at the rate of 7.5%. So then on this 80,000 you have to charge 7.5%. Then we'll be getting the NPBT, we'll be getting the tax, and then accordingly we have to do the calculations. Okay. So part solving this is going to take lots and lots of time. So that's why just understand the flow of the question right now. Then you can just practice it tomorrow. Okay. So from the NPBDT, so this particular question, this will help you to understand that first we have to calculate what is going to be the NPBDT for, your old machine as well as your new machine. And once we got the NPBDT, we calculated the differential amount. So we got the increase in the NPBDT, and that increase in NPBDT we subtract by depreciation. We get NPBT, then we subtract tax and PAT, we add the amount of the depreciation to ultimately get something which is called as your cash inflows. Okay. And then, my dear students, we'll be having present value of salvage. So we'll be having total PV of CI, and then we are going to subtract the PV of CO. Ultimately, we'll be getting the NPV. Okay. Now we are going to discuss some important transactions from this question. Now see, this particular practical problem 1 is also very important. Now all these questions now, practical problems are already solved in your it's already there in your revision series which is there. Okay. So here I'll be just discussing the important parts. Okay. So now in this particular case, in your question number 1, this annual cash inflow, this will be treated as your cash inflow, which is your savings, etc. So this is on per annum basis. Useful life is 4 years, salvage is 0, IRR is 12%, and profitability index is 1.064. Now in this particular case, what is the cost of the project? So cost of the project is actually called as your PV of CO. Now, how do you calculate your PV of CO? So your PV of CO is nothing but, whatever is your cash inflow per annum, you multiply that by PVAF, will be getting PV of CI, right? Now at IRR, PV of CO and PV of CI both are same. So what you can do is, you can take this 1 lakh rupees cash inflow, multiply that by PVAF at the rate of 12%. So at the rate of 12%, if you take the total of this, so this will be the PVAF, so this will be PV of CI. And once we get the PV of CI at IRR, your PV of CI and PV of CO both are same. So based on that, you are going to get, what is going to be the cost of the project. What is cost of capital? So here, my dear students, to calculate the cost of capital, it is that discounting factor at which your PI is 1.064. So what you have to do is, PI is PV of CI upon PV of CO, right? This is what PI is. So if your PI is 1.064, what is your PV of CI? It is nothing but cash inflow per annum. Multiply that by PVAF, and then the PV of CO, which we already have it. So based on that, you will be getting finally what is going to be your PV of CI once you'll be getting. And once the PV of CI is available, we have the cash inflow per annum of 1 lakh. So the differential part will be treated as your PVAF. So we are going to use the same formula. Cash inflow per annum into present value annuity factor, that gives you PV of CI. So at profitability index, first calculate your PV of CI, and then we have cash inflow per annum, we have PV of CI available. What is the annuity factor? We have to find out that, and this will be in any one of this particular part. It will be your cost of capital or your discounting factor, which will be available. NPV will be PV of CI minus PV of CO, and payback period will be calculated by taking cash outflow upon cash inflow per annum. Okay. Now in this Lockwood limited question, there is nothing new apart from the fact that here in this particular question, what about the utilities? What are we going to do about the utilities? So what are these utilities? These are nothing but infrastructure setup cost. Okay. So let's say, for example, if I am replacing split AC machine with the split AC machine, so then there is no additional utilities which I'm going to incur. Okay, so I can just do little bit of modification and that particular split AC can work. But if I'm replacing split AC with a window AC, then existing infrastructure or utility is of no use. So I have to throw it off and I have to purchase the new utility. So in that particular case, what is going to be the NPV? We have to work on that. Okay, so that is pertaining to your question number 2 about how to deal with your utilities. Okay, and normal question of calculation. Question number 3, also the same part. There is nothing new here. Okay, now question number 4. In this particular question, we deal with your what is going to be your synergies. So just imagine a situation where we have projects, let's say for example 1, 2, 3, which are done on isolated basis. So if you do project 1 on isolated basis, your PV of CI minus PV of CO, that will give you your NPV, right? So we are going to have 3 projects NPV. But if I take projects 1 and 2 together, then we need to check, are we enjoying any synergies or not? So what are these synergies? These are nothing but kind of benefits which we are going to get if we take both the projects put together. If I take projects 2 and 3, I need to check synergies or not. If I take projects 1 and 3, I have to take synergies or not. And then 1, 2 and 3, if I take it together, what is going to be my NPV? This is the objective of the question. So you have the synergies available. So if you take 1 and 2, there are no synergies. But if you take 2 and 3, then in that particular case, you are having synergies. Where is the synergies which is happening in 2 and 3? So there is synergies which is achieved in marketing and producing cost. And because of which the present value of cash inflow is 6,20,000. So if I just take 2 and 3, it is coming as 585. But because if I take 2 and 3 jointly, but there is going to be lower advertisement cost, and because of which the PV of CI is going to rise. So it's going to be 6,20,000. Okay. And if all the 3 projects are undertaken simultaneously, then in that particular case, what is going to be the impact? So basically, we have to calculate NPVs by taking different streams of the cash flows. Okay. Then my dear students, in this particular question, as you all can see, there is no cash inflow from projects which is given to you. So whenever the cash inflow from the projects, you don't find it in the question, at that point, we use something which is called as NCO method. So what is NCO? Net cash outflow method. So under NCO method, what you do is you take A plus B minus C, where A is your PV of initial investment, B is your PV of running cost, operating cost, and C is your salvage. And then we calculate NCO, and if the project lives are different, we calculate NCO on per annum basis, and then we are going to select the project in which the NCO should be higher the better or lower the better, then the answer is lower the better because it's your net cash outflow. Okay. Then my dear students, the next question which we are going to study will be pertaining to your this now given, where I told you that whenever there is going to be any commission income, this has to be treated as your opportunity cost, and this opportunity cost needs to be subtracted from the cash inflow. But if suppose this is after tax, then it will be subtracted from the cash inflows directly, and if it would have been before tax, then from your NPBT you'll be getting depreciation, NPBT, etc. And from your NPBT, before you subtract the tax, you first eliminate the commission income and then you calculate your NPV. So that is something which is the objective of that question. Okay. Now in your question number 9, here the crux was the loss of any year will be set off with the profits from the subsequent 2 years. So in this particular question, what you need to do is, we have to first check by what is going to be your NPV calculation. So here in this particular case, for year 4 and 5, the number of units are same, and 6, 7, 8, the number of units are same. So instead of, calculating in totality, what we'll do is we'll calculate it on per annum basis, and then we will see that, what is going to be year 4, year 5 cash inflow, and 6, 7, 8. There is no need to prepare 3 columns. Just prepare for any 1 column, because in all the 3 columns, your number of units are the same. And then we can discount it and bring it to the present value terms. Okay. Now in this particular question number 9, what you need to understand is that any loss in a particular year will be set off with the profits from the second year for the subsequent 2 years. So just imagine that in year 1, suppose there's a loss of 100. Will you pay any tax? No. So this loss of 100 will continue. Okay. And then to this, you will add the amount of the depreciation. Suppose the depreciation was 300. So then 200 rupees will be treated as your cash inflow. But my dear students, when we are going to take into consideration, for example, one more thing. Let's say, for example, we are going to take into consideration, in the second year, there is some profits, and the profits amounts to 500 rupees. Now you don't have to pay the tax on the entire 500 because this loss is allowed to be carried forward and set off. So from your 500 rupees, first you will subtract 100 rupees, you'll be getting 400 rupees. And on that 400 rupees, then eventually what is going to happen is you are going to pay the tax. So remember that whenever there is set off of loss, is it allowed to be set off for subsequent 2 years? So can you adjust it with the amount of the profits? Come on, yes or no? Yes, sir. And deal with that accordingly. Okay. Now this question number 10, it's a very large question. So I'm not expecting this question to be asked in the examination. But here in this particular question, we have to understand that there are 2-3 important aspects here. That if suppose you had any particular contractor which you appointed and you are making the payment of contract charges, but when we don't make the payment of the contract charges, what happens is there is some savings in the contract charges, and this savings will be treated as your cash inflows. Come on, yes or no? Yes, sir. Also at the same time, if suppose there was some premises which was actually given on rental basis, okay, but now because of you are producing a new product, then that particular rental payment you are not making, that rental income you are not getting it because you are using that particular premises for some different purpose. Then in that particular case, whatever is going to be your inflow avoided, that will be treated as your outflow. That also needs to be adjusted. Here the beauty is, how do we calculate actually your working capital? So working capital, my dear students, you have to understand that for working capital, they have told you that in stock of material before the commencement was 60 lakhs at the start of year 1. Okay. And then at the end of year 1 to year 3, it should be 165 lakhs. Now just imagine a situation at year 0, you have to maintain a stock level of 60 lakhs. But at the end of year 1, you want to maintain a stock level of 165 lakhs. So what is the additional amount of working capital which is required at the end of year 1? So that will be 105 lakhs. Now this 105 lakhs is the additional amount of working capital required, which keeps the stock level to 165 for all the years. So there is no need for any additional working capital. But at the end of the project, what happens is that this particular amount of working capital will be recovered. So this entire amount of 165 will be recovered at the end of the project. So that is something which was important in this question. And also, you have to understand that this 40 workers, now this is nothing but your irrelevant cost, because anyway you are making the payment of idle payment to your wages. Now this particular labor, you are going to use it for the purpose of production, then it does not result in any additional cash outflow, and hence we don't consider that in decision making. So just imagine that you are a CFO of a company and you are already making the payment to labor who's not doing any work. But now if you decide you want to start with the manufacturing operations, and in that you're going to use their time, so you're not going to pay them extra. So then that much amount which you're paying anyway, which was your idle time, then that will not be taken into consideration as a cost, because it's irrelevant in nature. You have to pay that cost irrespective of the fact whether you manufacture it further or not. Okay. Then apportionment of expenses, we don't consider that for your decision making. I told you at the beginning only. Okay. Now this question number 11, this is also important because this question also has replacement decision question, and here in this particular question, the difference is that there are other machines in the block of the assets, but the treatment is the same. So what we need to do is, let's say for example, you are purchasing the new machine for how much amount? You are purchasing the new machine for 10 lakh rupees. And from that, your exchange value is 2 lakhs. So 8 lakh rupees. So your value of the block is going to be enhanced by 8 lakh rupees. So use that 8 lakhs and then, on that you can charge the depreciation. Rest all income statement will be the same. So you can calculate your net profit before depreciation and tax as usual for existing machine as well as for new machine. The difference between the two will be called as your incremental part. And then from that, you are going to subtract the depreciation. So depreciation will be charged on 8 lakhs, and that's how we're going to do it. Okay. Question number 12 is regarding your optimum replacement time. This is the type of the question which can be asked because it's been very long that the question is not asked here. So this helps you to understand that when should you replace the machine. Okay, at the end of which year. So you can replace the machine immediately, or at the end of year 1, or at the end of year 2, year 3, year 4. But because the new machine has a life of 10 years, then we have to first calculate NCO per annum. So now when you replace the machine immediately, what is the salvage which you are getting right now? 90,000. So 90,000 is the salvage which you are getting, and every year how much is going to be your NCO per annum we have to check, because for the new machine there will be original investment plus whatever is your operating cost minus whatever is the salvage. So that NCO on per annum basis will be subtracted from it. So similarly, NCO per annum will be subtracted from every at the end of every year from which you are thinking about replacement is going to happen. But as and when the life of the machine keeps on increasing, can I say the maintenance cost will also rise? Come on, yes or no? Yes, sir. And the salvage value is also going to fall. So in this particular case, your maintenance cost is going to rise and the salvage value is going to fall. So we need to check that where should we replace, at what particular point we should replace. So then if you are replacing the machine at the end of the 3rd year, then you have to consider maintenance cost at the end of 1st year also, at the end of 2nd year also, at the end of 3rd year also. And then you will take the salvage at the end of the 3rd year. We will consider NCO per annum, and then we will see that when this particular machine should be replaced. It should be replaced where the total cost is going to be least. Your NCO per annum is going to be the least. Okay. So that's it, my dear students. Now, basically all these concepts I've covered in your investment decisions. Okay. Now, I just want to tell you that when it comes to your other chapters, like let's say for example ratios, okay, then we have leverages, then we have estimation of working capital, receivables management, cash management. Now these chapters in your revision test series only, all the questions are comprehensively solved, and these chapters are there for 1 hour each. So instead of you solving it or trying to solve this on your own, what you can do is refer to these chapters from the revision test series. So from the revision series videos which I've uploaded in the same playlist. Okay. And in this revision series now, all these chapters, all the study module questions, I have solved it. So in 1 hour, if you just watch this video, the entire chapter will be over. So this is how you can just take into consideration your ratios, leverages, estimation, receivables management, cash management. But apart from that, the difficult chapters which were there, which was cost of capital, capital structure, then also your dividend decisions, investment decisions, all these things we have taken into consideration here. So don't worry about all these things. But yeah, all these chapters now, just refer to the revision series which is there. Okay. And just refer to the revision videos. There I've solved the questions literally. So then it will be much more helpful for you rather than just going through the formulas. Okay. So with this, my dear students, I'm ending my today's session. I hope you all have enjoyed what we have done. You all have liked it. And wish you all the very best for your examinations. Okay, if you have doubts etc., then definitely you can ask me. Okay, and now I just want you all to revise FM, do more of your FM till tomorrow afternoon or something. Okay, and then post lunch you can start with your SM throughout the day, because if you just do your remaining chapters of FM till tomorrow, around lunchtime, this all chapters will be done, because leverages etc will hardly take time. Leverages, cash management etc will hardly take time, so you can just do that there. And then after lunch you can start with your SM. And one more important announcement, that theory video I have already uploaded in the same playlist, so you can just refer to the theory video, and that theory video you can watch it on Monday morning. Okay, and in that Monday, when you watch that particular video, your entire theory will be completed. Also at the same time, in the Telegram channel, I am posting PYPs and RTPs theory questions and answers, so you can just download that from the Telegram channel, and those theory questions you can just go through it, you can just read it. Okay, so if you have time on Monday, just watch that particular video, so that 10 marks will be secured regarding your theory part. And if you want to refer to the questions, you can visit the Telegram channel which is there in the description, and based on that you can download the theory of past 7 PYPs and 8 RTPs also. Okay, so everything is comprehensively covered in that video as well, so don't worry about it. Okay, so that's it my dear students. I hope you all have understood what we have done today, so wish you all the very best. Attempt your FM paper properly. Okay, start with the sequence. Okay, and don't be in the haste of calculations, and don't try to solve everything very quickly. Do step by step. Okay, and with a very calm mind and peaceful mind, I'm very sure you'll be able to attempt the full paper and score amazing marks in this. Okay, so that's it my dear students. Bye guys, take care. Good night everyone. Take care. Do share this video for those who are in need, and take care. Bye guys, take care. Thanks. And also, whatever is your